So we are doing two issues today. Okay. So we are doing a standard that we call income taxes. Okay. We know that, okay, as an entity, as far as you are using the natural resources of a country to generate revenue, okay, you have to pay something on whatever you are generating from using the resources so that we can still maintain, or we can maintain the resources so that you can continue to uh, benefit from that particular resource. So if it is if it is mining that you are doing, you are using our natural resources and you are going to be using our road. So how do we make sure that this road or these issues or these resources are going to be there for future generation also to come and enjoy? It means that we have to find a way to what to cater for the future generation. So you have to pay tax on whatever you are generating from the resources that you are using, or the nation's resources that you are using. So it is a corporate responsibility, not corporate responsibility, it's a legal responsibility of every entity, every company. If you say company over here, we are talking about what? Uh, Limited liability companies, okay? They pay taxes on their profits, but through operatorship, they pay tax as an individual. The company does not pay tax. Partnership, the company does not pay tax, but it is the partners that are going to be paying tax on the profit that they are receiving. But as a company on its own, the company is going to be paying taxes on their what? On their profits. Okay. So these taxes that you are going to be paying, okay, how do you go about it? You have to know that mostly the entity will prepare the financial statement and give it to the tax authority before the tax authority will determine your tax or liability. So if your financial year end is January to December every year, it means that from January to December, you will never know the amount of tax that you're supposed to pay on your profit, the tax that you'll be paying on your profit. So if your financial year is January to December and at 31 December 2021, you won't know your actual tax liability because you have to prepare this statement and give it to the tax authority to now determine your tax liability. They will allow certain items of what? Of expenditure, or they will allow certain items of revenue and disallow some of them. Then they will now determine the actual tax liability for you. So the issue is you are now what? You are now preparing your financial statement at this one. Are you going to be keeping your financial statement till the tax authority will determine the tax before you bring the tax into the statement? No, you cannot prepare your financial statement open. You have financial statements, you have your revenue, you have your cost of sales, you have your gross profit, you have your expenses. Then you just leave the tax expense here. You will not write any figure here. Then you leave the tax expense. Then you will not determine profits. You will not even prepare your statement of changes in equity. And you will not prepare your statement of what? Financial position also, because you have not determined the profit for the year. So you leave the statement open like that. No, you cannot do that. Okay, you cannot do that. So since you cannot do that, and you also don't know the amount of tax that you pay until the financial year ends, they are telling you that you can make an estimate of the tax that you are going to be paying. Okay, so last year I made a profit of 20,000 and the tax that we paid was 2,000. Now we are expecting to increase our profit by 20%. So we are also expecting the tax to increase by, let's say, 15%. So you can make estimates of that tax and put it in your account here. Why are you making the estimates? We want you to prepare the financial statements. We don't want you to leave the tax space open. Wait for the tax authority to determine the tax liability in the what in next year before you come and put it over here. Just make an estimate of the tax. Okay. So how much do you think you can pay on the profit? Okay. I might be paying 20,000. So just put the 20,000 here. Then you have your profits for the year. Then you can use that profit to do your what? Your other stuff. Prepare your statement of changes in equity and prepare your statement of financial position. Then If the tax authority now determines what the tax that you pay, you can now do the necessary what adjustments. Okay, so we are going to be looking at the issues of current tax and the issues of deferred tax. What do we call current tax? It's just what I've said now. The tax that you are going to be paying on your current profits. The tax that you are going to be paying on your current profits, what we call the current tax. So we'll be looking at the issues of ISO. We'll be looking at the issues of what? Current tax. And another one that we call deferred tax. Okay. So we'll be looking at issues of deferred tax in details and the current tax. So the current tax is the tax that you are going to be paying on your current profits. So if your profit for the year is 20,000, the tax that you pay on that 20,000 is what we call the current tax. But how does the current tax work? Okay, the current tax, how does it work? Okay, very simple. We have agreed that the tax authority, the actual tax that you are going to be paying on your profits, it will never be known until you have prepared your financial statement and submit your financial statement to the tax authority. What it means is that the tax figure that you might be putting in your statement is not what? It is not the actual tax. Okay. And we cannot also wait for the tax authority to determine the tax before we pay. Let's assume that, okay, let me just use some figures. Let's assume that our revenue for the year is 20,000. Okay. Our cost of sales, let's say, is 13,000. Okay. So we have a uh, gross profit of 7,000. So I'll just say, let me just say other expenses excluding tax. So our other expenses is, let's say, 2,500. Okay. So our profit before tax, profit before tax is going to be 4,500. Okay. Now we need to subtract the tax because the tax will be paid on the profit. So it's going to be reducing our profits. But we don't know the tax that we are going to be paying because we have to now submit the statement to tax authority. Then they will now deduct certain items and also allow certain items to determine the tax for us. So we cannot leave this place. You can say, okay, we don't know the tax that we are going to pay on the profit. So let's leave this place like this. Then let's wait on the tax authority to determine the tax before we come and complete this one. It doesn't make sense. What if the tax authority will take 4 months to determine the tax? You cannot leave the financial statement for 4 months before you come and prepare. No. The users want the financial statement to make decision. So since you don't know the tax that you are going to be paying and you cannot leave your statement over there, it is allowed that accountants should make an estimate of the tax that they think the company will pay. This estimate can be based on the past records. Last year we made a profit of 15,000 and the actual tax that we have paid was 2,000. Now we made sales of 15,000 and the tax that we have paid was 2,000. Now we are making sales of 20,000. So we are expecting our tax to increase by at least 500. So you can bring only 2,500 over here to have your profits for the year 2000. Then you use this figure now to prepare your statement. Okay. Then in the following year, the tax authority will now receive your books and now do calculation for the actual tax. So it can happen that in the following year, the tax authority will say that, okay, the actual tax that you have to pay, is supposed to be 2,200. It means that if you should know this 2,200, you will be subtracting 2,200 over here and be having a profit of 2,300. But you have subtracted 2,500, which the actual amount should have been 2,200. You can see that you have over subtracted the figure. So you have reduced the profits. Okay, that's one way. Then, assuming the tax authority is now telling you that the money that is supposed to pay should be 2,700, it means that if you should know the 2,700, you'll be subtracting 2,700 from this particular one. So you subtract 2,700 and you'll be having a profit of 1,800. So it means that you have subtracted 2,500. You have under subtracted or undercharged your tax. Okay. How do we go about this undercharging and overcharging? That is what we are going to be looking at for the current tax. The current tax, you will never know this particular tax until the tax authority has given the figure. So the actual tax payment will always be known in the West in the following year. But you have been allowed to make an estimate because you cannot leave your financial statement open. So the tax has been determined by the tax authority. Just make an estimate of the amount that you think you pay. So if you make an estimate of 2,500, you are telling us that you are going to be paying 2,500 to the tax authority, and you have not paid that amount at the end of the year. So that will be treated as a liability for you. So are supposed to pay 2,500. That is the amount that we are estimating to pay the tax authority. So if the actual amount should be 2,500, it means that we are owing them 2,500 at the end of the year. Okay. Now the tax authority will now determine the actual tax in respect of what? In respect of the previous year. And they are now telling us that the actual tax that we're supposed to pay is 2,200. But we have charged a tax of 2,500. It means that we have overcharged our tax by 300. What is the impact of that 300 on our profits? It reduces our profits. Okay. If they are saying that the tax is 2,700, we have charged 2,000 what? 2,500. What is the impact of the 200 that we undercharged? It has increased our profits. So what do we do? That is what we are coming to look at. Okay, so we'll be looking at the issues of under provision and over provision. Since it's going to be an estimate, you can underestimate or overestimate. So we are going to be looking at when there's an underestimation and when there's an overestimation, how do we go about it? So I'll still bring some figures there and look at the impact. Okay, let's come here. Okay, so I'll come here. I'll have the I'll have revenue again. So let me bring revenue here. Okay, revenue here, that is 25,000. So let's have our cost of sales to be 15,000. Then we have gross profits. So I have gross profits here. Gross profits here to be, let's see, 10,000. So I have my other expenses excluding tax. That is 5,000. And I have 5,000 as net profit before tax. Okay. And our tax expense, the estimate. Our tax estimates, we are estimating to pay 3,000. Okay. So the 3,000 will come here. I'll have 2,000 as the profit for the year, or profit after tax. Okay. Then let's say this is 2021. Then in 2022, we will now submit our 2021 financial statement to the tax authority. Okay, so 2021 in the statement of financial position, this is what I'll be doing. So let me show that one. Statement of financial position. I'll be having current liability here. And under the current liability, I'll be having tax liability, which we call the current tax. Okay, the tax on the current profit. So we have 3,000. We are saying that we are going to be paying tax authority 3,000. That's the tax that we say we are paying them, but we have not paid. So it's an amount that we are owing. So we have the current liability there. This is for 2021. Okay. Then in 2022, you will now submit your 2021 financial statement to the tax authority. Then they will now determine the actual tax because their profits that they are going to be charging the tax on might be different from your profit because you are determining the profit using what? Using accounting principles. They will determine the profit using tax principles. So they will be allowing some of the expenses and they will be disallowing some of the expenses. So it's going to be making your accounting profit different from their taxable profits. So they will now give you the actual tax. So the question will tell you that the actual tax paid, the actual tax paid in respect of tax in 2021. Okay, tax in 2021. They are saying that the actual tax paid is 2,500. Okay. So it means that the tax that we should have subtracted from 2021 profit should be how much? what should have been the figure to be subtracted from 2021 profit?
2,500.
Okay. If we should know the 2,500 and subtract, what would have been the profit after tax?
2,500.
Okay. Okay. You can see that we have underestimated our profit by what? By
50.
500.
500.
Okay.
Okay.
Because of the tax, isn't it?
Yeah.
Okay.
Yes, sir.
But the issue is, you see, this 2,000 will be included in our return earnings for opening return earnings for 2022, isn't it?
Yeah.
Okay. The what we adjusting return earnings now means that we are doing a retrospective adjustment, isn't it?
Yeah.
Okay. We have only two things that we can do retrospective adjustments for. These two things are whether we are correcting an error or we are changing accounting policy. If you come here, this is just a figure that we are estimating. We are not changing accounting policy. It's not an error that we are doing because we don't know the actual amount and we are charging a different one. We don't know the amount at all. So we are making an estimate. Okay. So this is an estimate. This is a change in an estimate. This is a change in an estimate. You cannot go back to your return earnings and add 500 to what? To the 2,000 that you have. You cannot go back and adjust 2021 figure because this is a pure estimate. We are making an estimate and this is a change in an estimate. It should have a prospective effect. So what we do is that this 500 that is under charge, you can see that we are supposed to pay you 3,000, but you are saying that we should pay 2,500. That is again to us. In other words, this is again to us. So we add it to our profits. But this one we cannot go back and add. So we treat it from this year now. So they will give you this year's figure now. Very simple. So they will say that you have made a profit. You have made a profit. So I will bring this one here. Okay. So 2022 here, let's see, they have given us information for 2022. Okay. So they give us of revenue of, let's see, 30,000, and our cost of sales is, let's see, 15,000. So we have gross profit of 15,000. Okay. Then we have other expenses. Okay. Other expenses, let's say the other expenses now is 7,000. So we have profit before tax. Okay. I'm including interest in the other expenses. So profit before tax. But what I would like do, the 500 that are supposed to go and add to the profit, I'll treat it here. So I'll come here and I'll have over provision for the tax. We have over provided. So our profit has reduced. So we have to come and add this figure. I'll come here and add 500. This is relating to tax. I will provide provided for the tax. Instead of me charging 2,500, I have charged 3,000. So my profit has reduced by 500. I have to go and add back. But I cannot go and add the profit that I have subtracted that figure from because it's a change in an estimate. I have to treat it for this year. So I'll come here and add. Okay, so this 500 is relating to the tax for the previous year. But this 8,000 that I'm making here, I'm supposed to pay tax on it again. So the question will tell you that, okay, the tax estimate that we are making on this one, let's say, is 4,000. We are expecting to pay tax of 4,000 here. So I'll come here and have current tax of 4,000 here. Okay, you see that I'll be having 4,500. Okay, let's come here. Look at this. You can see this 500 is relating to tax, isn't it?
Yeah.
Okay, and this is also tax.
Yeah.
Okay, you cannot have two accounts for one item. Okay, this is what is the impact of this on our profits? The 500.
It's increasing it.
Okay, what is the impact of the 4,000?
It's decreasing it.
Also reduce it.
Okay, so what is the net impact of the tax on the profits now?
3,500.
3,500.
Okay, so I will just net this one. This is coming as a gain, and this is coming as an expense. So we'll just net this one and have 3,500. So I'll subtract 3,500 from this and I have my 4,500. Okay, so you can see what are we doing? This is over provision. What are we doing to the current tax with the over provision?
It has reduced.
It's
By
reducing
500.
our profit for the next year.
Okay. So we are reducing our what? Our current tax by 500. Okay. It's not because this is supposed to be subtracted from the 4,000. No. The 4,000 over here is the tax that we are estimating to pay on a profit of what? 8,000. Okay. This 500 should have been taken to 2021 year. But because it's a change in an estimate, that's why we are treating it over here. This 500 does not change the fact that the tax that you are going to be paying on the current profit is what? Is 4,000. Okay. It does not change the fact that the current tax on 8,000 is 4,000. The 500 is just coming in because instead of us going back to add the 500 to 2021 profit, we don't want to add because it's a change in an estimate. So we should treat it in this year. So your current tax liability will still be 4,000. Why? This is the tax that you are paying on these profits. The 500 is just coming in because you have refused to add it back to last year's profit because it is changing an estimate. It doesn't change the fact that your current liability will still be what, 4,000. Okay, so we are going to be looking at the treatment of over provision. Treatment of over provision. If there's an over provision, it is clear over here that if it's an over provision, we are reducing our current tax by what? Okay, I can't believe this one now. Okay, so when there is an over provision, okay, when there is an over provision, this one is this one. So when there is an over provision, so we are looking at treatments. I will look at over provision here. When there is an over provision, okay, we take our current tax. So you have your current tax. The current tax is the tax that current tax estimate is the tax that you are saying that you are going to be paying on the current tax. So you have that one. Then your over provision, which is you have overcharged the profits for last year, which should be increasing the last year's profit as a gain. You since it's a change in an estimate, you bring it here as a deduction. Okay, so you have your figure over here taking to profit or loss. Sometimes we adjust the deferred tax against it, but for now we'll be maintaining this one. Okay, they can also give you just a balance. They will not say this is under provision, this is over provision, but they will just put a tax at a particular side of the trial balance, or they will say after last year's tax or after tax relating to last year has been paid, there's a debit balance of this on the what on the tax accounts. What does it mean? Credit balance, what does it mean? We are going to be looking at that. So let's come to tax accounts. Okay. Let's come to tax accounts. Okay. We are doing this in 2022. Okay. In 2021, what is happening? We are owing the tax authority. The amount that we say we are owing them is 3,000. Do you agree? The current tax for that year was 3,000. That is going to be 2021. Okay. So let me just do this one straightforward. I'll just have profit or loss here. Okay, because I'm taking it to profit or loss 3,000. So 2021 here, it's 2021. So I'll close this particular account because I'll be paying these people in
Yeah,
next year.
it's
So
100%. Okay.
I'll close this one and go and pay these people. So I'll see I'm paying them 2022. So I'll close this account. Okay. So I'll come here, it's a liability. So I'll have balance brought down in 2022 as 3,000. How much has been paid? How much has been paid in
500.
respect of?
500.
Now it's 2,500. Okay.
2,500.
So we have paid a cash. Okay. So we debit our liability. Liability will be reducing and cash will be what? Cash will be increasing. Liability will be reducing, cash will be reducing. Okay. We are paying cash. Okay. So we come here and have 2,500. You can see that we'll be having 500 as a balance. Is that correct?
Yes, yeah.
The 500 that we are having as a balance, are we owing them?
No, we are not owing them.
No, they are owing us.
Okay. No, we are not giving them 3,000. We are saying that we should give them 3,000, but they are saying that the amount that we supposed to give them is 2,500. So it means that we have to cancel our accounts, which is in the name of over provision by 500. But let's assume that we are not bringing over provision over here. You will want to close this
Sir,
out. So you'll be having balance carried down over here as 500. Assuming you don't want to name it as what? As over what? Provision.
over provision, yeah.
You'll be having balance carried down over here. Okay, which will give you 3,000. Which will give you 3,000. Okay. Then you come here, your balance brought down will be what? Will be 500. But this 500 is not always. It is what? It is over what? Provision. Okay. So the question will tell you that after the tax has been settled for the previous year, there is a credit balance of what? 500 on the tax account. It is not always. That is over provision. So whenever you see current tax at the credit side of what? Of the trial balance, it means that that is what? Over provision. Over what? Provision. So we are saying we are paying them 3,000, but the actual amount is what? 2,500. We have provided for 3,000, but the actual amount is 2,500. Our provision has reduced by 500, which is again to us. A reduction in provision is an income. So we just come here and do profit or loss over here. But I don't want to do it because I want to show you when they see a credit on the current tax account, what does it mean? When you see a credit, this is over provision, which will become opening balance here as a credit balance. So when they see a credit balance on the current tax accounts, that is over provision. And over provision is a gain, should be net against the current year tax because that should be added to the profits. But we are bringing a tax which is an expense, so we net it. It doesn't change the fact that the current tax will still be what? Will still be the liability for this year. The 4,000 is on 8,000. The tax that you are paying on the 8,000 profit is 4,000 for this year. So your liability for this year will still be 4,000. Okay, it will not be 3,500. You are treating the 500 because instead of you adding the 500 to last year's figure, you you are not adding, you are bringing it to this year. So that 500 is relating to last year, not this year. But just that you are not treating it in last year because it's a change in an estimate. Okay. Then we come to the issue where we have that one too. We still be continuing with that particular one. Okay. Now we made a provision for 3,000. The tax authority is now telling us that tax paid, the actual tax paid is 3,500. What is happening? If the actual tax paid for 2021 is 3,500,
We have
Yeah,
underpinned that
understand.
previously.
Underprovided.
okay,
The overpayment of 1,000.
okay. I just want to hear that you have what? You have paid 500 in addition, isn't it? Okay,
Yeah.
we estimated for 3,000 and we are paying 3,500. What it means is that our actual tax expense for 2021 is 3,500, but we subtracted only 3,000 from our profits. What does it mean? What is happening to the profits?
We overestimated the profit.
Okay, so we need to go back and subtract 500, isn't it?
Yes.
Okay, but we are saying that this is a change in an estimate. So what do? We have to subtract the 500 rather from this year's profits.
Yeah. Yes.
Okay, okay. If we are making sense with that, then I'll come to this place now and now scroll up. Okay, so I will. Okay, so I will erase this thing now. This one nicely. So I'll take these ones off nicely now and have this one. So I'll still use the same thing here. So I'll come here and have this figure. Okay. So I have profit before tax to be 8,000. So what I will do over here is that I will do under provision of what? 500. Is that correct?
Yeah.
Okay. Then the current tax is what? The tax for this year itself. The tax that we are
3,000.
paying on the what? On the 8,000 itself is 4,000. Okay. So you can see that the 500 is relating to which year? Last year, isn't it?
Yeah.
But what is the tax that we are paying on the 8,000 for this year?
It's 4,000.
So how much are we owing the tax authority for this year?
4,500.
No,
It's 4,000.
It's 4,000.
it's 4,000. The 500 already, we have paid the 500, we have paid a tax relating to the 500, but we have undercharged our tax. That's why we are bringing the 500 over here. But the actual tax that we are paying on the current profit is 4,000. Okay, you can see that I will be having something like 3,500. Okay,
Yeah.
you can see that in fact I'm subtracting 4,500 from my what?
From the revenue.
Okay,
From the profit
From
before
the
tax.
profit
on the
tax.
profits. How am I getting the what? The 4,500. I'm adding the 500 and what?
You are adding the
The
undercharge from the
4,000.
previous year budget to the current year's estimate of 4,000.
Okay, you can see that both of them are expenses, isn't it?
Yeah.
So I'll just put them together. Okay, so when there is under provision, please we add it. It's supposed to reduce our profits, and the current tax is also reducing our profits, so we add it to that one. Okay, so let me come to the issue of under provision, the treatment we add. So we come here and have under provision. When do we have under provision? When your estimated tax is lower than the actual tax that you are paying. So you always come with your current tax. Okay, current tax estimates. That is going to be something here like this. Then your under provision. Under provision is the actual tax that you are paying in relation to the previous year and the estimate that you made. So I'll come here and have something. We come and adjust our deferred tax with it. That is when we are done with what we are done with our deferred tax. Okay. We have said that whenever they see there's a credit balance on the current tax accounts as a result of payment for last year, it is what? It is over provision. The reverse is what is true. When you have a debit balance for this one, when you have a debit balance after settling your previous year's what tax, it is under provision. So we just use some illustration to demonstrate that and move on. Okay, I'll come here. I'll be having a tax accounts. Okay, tax and liability accounts. Okay, so 2021, I'm saying that I'm owing them. So we come to 2021 here. I'll come to the currency sign. So 2021, I'm saying that the amount that I'm owing them, I'm taking this one to profit or loss 3,000. So I'll pay them in the following year. So I'll bring this balance forward, 3,000. So I have 3,000 here, 3,000 here. Okay. So I'll have balance brought down in 2022 of 3,000. But I've made a cash payment of 3,500, which is going to be 2022. Okay. This one, please, I'm not overpaying. It is not advance payment. The amount I'm paying here is the actual payment for the tax. So it's no advance payment. It doesn't mean that the tax should have been 3,000 and we are paying 3,500. No. We are just estimating. They are telling us the actual tax should have been 3,500. So we are paying this in respect of the previous year's tax, which is 3,500. So we should have been 3,500 against 3,500. But we provided for only 3,000. So if I'm closing these accounts now, you see that I'll have balance carried down here, which is actually under provision by 500. I will close these accounts and I will close this one too. I will bring the balance draw down here for 500, which is actually under provision. So when they say there's a debit balance on the current tax account after settling the previous year's tax, that is under provision. So if you see current tax figure at the debit side of the trial balance, that is under what? Provision. So you just go and add it to your current year's profits. Okay. So they can give you a question where how do you normally examine this one as a standard? Okay, they can give you a question where they will say the tax that has been provided for last year and the tax that has been paid in respect of this year. And they will give you the current tax estimate for this year. So you just determine whether there's an under provision, over provision from the previous year. Then that will be added or subtracted from the current year's profit. Then the difference will be taken to profit or loss, and the current year tax will be taken to what? Statement of financial position. It doesn't mean that if you are taking 3,500 to profit or loss, the same 3,500 should be taken to statement of financial position. The figure that will be taken to statement of financial position is the amount that we are owing the tax authority in respect of current year tax. Whatever is bringing the under provision or over provision is relating to the previous year, which should have been treated in previous year's financial statement. But we are not treating it there. What it means that if those figures should have been treated in the current year's profits, our tax that we are paying for 4,000 will only be the figure that will be subtracted from the profits. So this is a tax for the current year. So if the 500 under or over should have been treated in the following years, our tax figure for this year will just be 4,000. But we are not treating them there. We are just bringing it over here. It's not because we are bringing it because to reduce our tax liability. No, we are bringing it because we cannot add or subtract from the current year profits. So we are just doing the subtraction here. Whatever we are doing with the under or over, it is relating to previous year, not the current year. So our current year, current tax is based on the current year profit. That is the amount that we are owing the tax authority. So whether under provision is reducing or increasing, your current tax estimate remains the amount that you are paying the tax authority, or you are saying that you are paying the tax authority based on the current profits. So your liability for each year will be the current tax estimate, the current tax that you are estimating on the current profits. Under or over provision is from, or is as a result of under provision for the following year, which you have already paid the tax relating to that. That is not always, that's not credit. That will be reducing your what, or increasing your tax liability or reducing your tax liability. It's just an underestimation relating to your previous year's estimate. Okay, that is very simple.
Hello, sir.
Yes, please.
So meaning in the statement of financial position, meaning our cash will also be reducing, right?
You are doing this at the end of the year. The amount has been paid during the year. So you have done anything concerning cash and those things already. That's why you already have the under provision. Yeah.
Okay, thank you.
Unless the question has said that nothing has been recorded in respect of that. Okay. If you haven't done the entries, you will not even know that that is a tax. That is under provision or over provision. So anything concerning tax has already been recorded. Okay. All right.
Hello, senior.
Yes, please.
So does it mean that the under and over will only be treated in the income statement, whilst the actual tax payable for the year is going to be treated in the statement of financial position?
Okay. If you are saying that you are owing me 3,000, okay, for goods that I've sold to you, but I've now told you now that okay, the actual goods that I've sold to you is 3,500. Okay, it means that you pay 500 in excess. You are estimating that you are owing me 3,000, but the actual goods that I've sold to you is 3,500. What will happen? You pay me 500 in addition, isn't it?
Yes.
Okay. Now you have given me the 3,500. It means that you have to go and change your estimate to 3,500 now, isn't it?
Yes.
If I've sold goods to you for this year, 4,000, the 500 that you're supposed to pay me, will it change the 4,000 goods that I've sold to you?
No.
That is the issue that we are doing. The current tax is based on the current profits. Okay, so the 4,000 is for the profit that you have made for this year. You are paying 4,000. So the current tax for this year, the tax liability for this year is 4,000. Okay, you are bringing the 500 because you cannot go back and subtract the 500 from the last year's profits. So since you cannot do that, you are just bringing it over here. It doesn't change the fact that the profit that you have made for this year is 8,000, and you are going to pay 4,000 on it. It doesn't change. Okay. So the current year tax estimate is the actual tax for the current year. The over provision is just coming in because you cannot adjust last year's was profits. So you are just doing the adjustment over here. So whatever you are doing with over and under provision is just because you cannot do it in the previous year's financial statement. So that's why you are bringing it over here. If you should do it over there, it means that they will not find their way to the current year's statement. So you only subtract the current year tax from it. I hope that is making sense now. Okay.
Yes, sir, it's making sense.
Okay. Shinagofi, are you there?
Hello, senior.
Yeah.
Yeah, it's okay.
I know the reason why I haven't answered your question straightforward. Okay. Because maybe you want to say that, okay, current tax will always be like this. But if you go and see tax credits, that will be affecting your current tax now. Okay. So maybe you want to say that whenever I see current tax, it will be a liability. But what if you have a tax credit? You can have a tax credit in the form of tax credit, not under provision. Okay. You can have a tax credit. The tax authority has wrongly charged you tax now. Okay, that is not as a result of over provision or under provision. That's the actual tax that they are charging you, which should not be charged. That will not be reducing your tax liability. So your current tax will not be reducing. Okay. So that is why I don't want to be straightforward. Okay, current tax should be like this. No, no. What if you go and see tax credits? That will be changing the narrative. But when you have issues with under and over, okay, under and over does not affect our current tax in terms of always. Okay. In terms of what? Always. In terms of always. Okay. That is it. Let's come to the issue of, so this is just about current tax. Okay. The issue of deferred tax. Okay. What do we call deferred tax? Very simple.
Hello, sir.
Yes, please.
Please, can you check the notes? I think the requirement for question 1 on page 1.
It is saying what?
The year, is it 2015 or 18?
Which one?
The requirement.
Or it's supposed to be 2018.
Okay.
Okay, let me change that now. Okay. Wow. Okay, so we come to the issue of deferred tax. Okay. First of all, I would like to state that deferred tax is not a liability. Okay. Deferred tax is not something that you are going to be paying. Okay. Deferred tax is not something that you are going to be paying. It's not money that you pay as in you are owing somebody, you go and pay. Okay. It is just an estimate of something that happened. All right. It's just an estimate of something that is happening now. And you are just trying to estimate the future problems that that particular thing will be bringing. Okay. So if you want to really understand the issue of deferred tax, then we need to be able to establish what we call accounting tax and taxable what profits. Okay, the accounting profits and taxable profits rather. Okay, accounting profits, it is the profits in the what in the books of the tax in the books of the entity. So the profit that you'll be seeing in the financial statement of a company, it is what we call the accounting profits. So we have the accounting profits, and so this is between the accounting profits. That's what the taxable profit. What is the taxable profit? It's a profit that the tax authority will be charging their tax on. Okay. There are certain items over here that can make the accounting profit different from the taxable profits. Okay. And these items, they are going to be allowable for tax purposes. What do you mean by it's going to be allowable for tax purposes? When you purchase non-current assets, the tax authority will want to motivate you to invest more in what in your current assets. So they will give you capital allowance on that particular asset. Okay, so you can purchase the asset and be charging a depreciation of let's say 20,000 on the assets every year. But the tax authority can be giving you capital allowance of 3,000. Okay, you can see that this asset is not going to be just an asset that you purchase for 1 year. That's the end of it. No. So you see that you are going to be charging this depreciation over some number of years. And the tax authority will also be giving you capital allowance over certain number of years. Okay. So if you are charging, you are saying that every year you are consuming 20,000 of your assets. Tax authority is giving you what? 30,000. What is happening here? You can see that the tax authority is reducing your profit every year by what? By 1,000. By 10,000. Okay. That's 10,000. Okay. The tax authority is reducing your profit every year by 10,000. What it means is that every year you are not paying 10,000, you are not paying a tax of what? A tax on 10,000. Because this is the actual amount that will be used to determine the tax that you're supposed to pay. Okay. So the tax authority is now giving you more tax savings now. You can see that you are enjoying because if you are saying that your profit after tax is supposed to be something like 30,000, the tax authority will be telling you your profits that we are charging tax on is what is 20,000. You can see that the 10,000 that you are expecting that will be there, which you are going to be enjoying tax benefits on it in the future, you have enjoyed that now. Okay, so the tax authority will give you pay tax on 20,000. It means that the 10,000 that you are expecting that the tax authority will subtract it in the future from your profits. You have enjoyed that now. What it means is that in the future, that 10,000 will not be available. So what will happen is that you pay tax on what? On more profit in the future than you are paying now. What is causing that? It is the more capital allowance that you are receiving now. So we are just trying to estimate the impact of the additional capital allowance that we are enjoying now. What is the tax implication in the future? We are just trying to estimate that. Why are we estimating it? Whatever is causing this or whatever will cause this in the future, it is what? It is now. It is happening now, just that we are not paying anything. But it's happening now. So using the accrual concept, we have to, since the transaction has occurred, we have to recognize it. So we are just trying to determine the impact of the additional 10,000 that we are enjoying now. What will be the future implication of this? That's what we want to determine. Okay, so I'll use figures now to demonstrate that. Okay, so we're doing accounting profits, and taxable profits as well. So I'll come here and come to accounting. I'll come to accounting profits. Okay. So I'll come to accounting profits now. So let's see profit before depreciation for the entity. So I will do 2 years, 2022 and 2021. Okay. So profit before depreciation. Let's say this place is 25,000 and this place is also 25,000. Let's say they are all the same thing. Okay. Let's say the entity is having 10,000. The asset is 10,000. They are using it over 2 years. Okay. They are using it over 2 years. So we have depreciation for the entity here. Depreciation for the entity to be 5,000. 5,000. Okay. So we having 20,000 for the 2 years. 20,000. So that is profit after depreciation. Let's say that the tax authority is paying tax of 30%. What is going to happen? What will be the tax every year?
$6,000.
Okay, that will be 6,000. 6,000. You can see that our profit after tax is 14,000 and 14,000. Okay, let's come here. Let's say we are coming to the books of the tax authority now. Okay, all these things are the same. Okay, all these things are the same. Let me just clean. Okay, someone said I should not be cleaning the examples. Okay, so let me come here and come to the tax authority now. Okay, so let's come to the books of the tax authority. So I'll come here, I'll have, this is for GRE. Let's say we are in Ghana, so GRE. So the first one is for the company. So I have 2022 and 2021. So I have taxable profit before capital allowance. Okay, or the profit before capital allowance. Let me just say profits before capital allowance. So profits before capital allowance. So before capital allowance. So we have the same profit, 25,000. 25,000. So let's say the capital allowance, the tax authority is giving us 7,000 now, and they will give us 3,000. Now, this one should be, so this should be 3,000, and this should be 7,000. So the value of the asset is 10,000. So they are giving us capital allowance of 7,000 the first year and 3,000 the second year. We'll be having 22,000, and be having 18,000. Okay, let's say they are also charging the tax at 30%. Change what will be the tax?
For 2022 to be 6,000.
6,000.
6,000.
600.
600. Okay, this year will give us what?
5,400.
5,400. Okay, what will be the figure for the two?
1,500 for 2022.
Okay,
16,400 for 2022.
16,400.
No, 15.
No, 15, 15,15.
Okay, 15,400. And this one is what?
And the other one is 12,000.
12,600.
12,600.
Okay. Our focus is not on the profits. Okay, our focus will be on the tax. Okay, let's come here. In our books, what is the tax that we are paying every year? What is the tax that we are saying that we are going to be paying?
6,000.
Okay.
Hello,
So
good
let's
evening.
come here. Okay. Okay. So let's bring those figures now. The actual tax that we are paying is what? For 2022. The one that the tax authority is giving to us, 6,000.
600.
600.
600.
Okay. And this is 5,000 what?
400.
100.
100.
Okay. But in our books, what is the tax? 6,000, isn't it?
Yes, 6,000 across board.
Okay. And the actual tax that we are paying is what?
Actual tax is 6,600.
No, 2021.
It's 5,400.
5
Okay. We are paying what? 600 less than what?
less than the actual tax.
Less than
Okay.
actual tax.
Okay. Don't treat this as over. Okay. This is not over. This is not over tax. This is not over provision, under provision. Okay. What is causing the difference over here is the treatment of what? Of an item. What is that item? Is the depreciation. So we don't assume that this is what this is under or over provision. Our tax estimate is actually correct. Okay, we are estimating 6,000, which is actually correct. But the tax authority is now saying that okay, you are estimating the 6,000 based on a depreciation figure of what? Of 5,000 every year. But we are going to be giving you 7,000 now. So if we are giving you 7,000, it means that we are giving you 2,000 more. Okay, we are giving 2,000 more. This 2,000 more that we are giving to you now, you are trying to estimate, okay, these 2,000 more that are supposed to be enjoying in the future that they are giving to me now, is it going to be available for me to enjoy in the future as part of the capital allowance? No. So it means that 2,000 of your profits in the future, you pay tax on it because instead of you enjoying this in the future, you are enjoying it now. So it's not because of under or over provision. It's not because the tax authority is allowing or disallowing. Issue of under provision, over provision is as a result of the tax authority allowing certain items and disallowing certain items. Over here, everything that we have treated is correct, but just that the tax authority is giving us something more than we should. And that particular thing that they are giving to us more, that particular thing that they are giving to us more is as a result of the capital allowance. So all things being equal, if the tax authority should be charging the capital allowance on equal basis, it should have been 5,000, 5,000. And our actual tax would have been the same. If the tax authority should be charging it on equal basis divided by 2, you see that our profits every year will be 14,000, 14,000 in the books of the two entities. And the tax will be the same. But what is causing it now? The tax authority is giving us capital allowance of what? Of 7,000. Okay, in the first year. But what we are expecting, what we are saying that we are going to be enjoying is 5,000. But the tax authority is giving us what? Is giving us 7,000. It means that they are reducing our profit this year by additional 2,000, which we are expecting to be a reduction in the future. Since this has been reduced now, since this 2,000 has been given to us now, in the future, will this 2,000 be subtracted from our future profits in relation to capital allowance?
No.
No. And what will be the implication of this? If this is not taken away from our profit, what will happen?
You pay more tax.
You pay more tax. Okay. Now, we are just trying to estimate what is the more tax that we are going to pay in the future as a result of the 2,000 that we are enjoying now. So we just come here and multiply this by 0.3 because we pay the tax of 30% on it. So what is the less tax that we are enjoying now? You can see that we are enjoying the tax of 600 here now,
Yeah.
which we are going to be paying in the future, isn't it?
Yeah.
Okay. So what we do over here is very simple. Okay. Very simple. We want to make the accounting profit and the taxable profit should be the same. Okay. How do we make it the same? The tax authority, it is now what? The tax authority is now subtracting something more. Okay. And we are charging less. Okay. What we do over here is this. We determine the implication of this. Okay. Implication of this. This will be a tax that we are going to be paying in the future, isn't it? This is going to be a tax in the future, which will be an expense. Since that will be an expense, we create that expense now. We are going to be creating this expense now. So this one we call it what? Taxable difference. What do you call a taxable difference? it is creating additional tax obligation in the future for us. They are giving us 2,000 now, which that 2,000 will not be available. So it means that instead of us subtracting this 2,000 for our profit, it will not be subtracted. So we'll be having a higher profit to pay tax on in the future. And that particular future profit that we are paying, what portion of the tax is as a result of something that is happening today? So we determine the future implication of what is happening today. That's what we call a deferred tax. So we are just estimating the tax that we are going to be paying in the future. But this tax, this 600 will actually be paid. How will it actually be paid? Let's come to this one. How will this particular 6,600 be actually be paid? It will be paid like this. In 2022, what is the tax that we are paying?
6,600.
Okay, which is the 6,000 that we are estimating plus the additional what? 600 that we are paying.
600.
Okay, so that tax, the deferred tax has already been factored into our current tax that we are paying. So that's why I said deferred tax is not actually liability that you pay. Eventually, the tax will be paid in the current tax, but we are just estimating this one. So let's come to this situation now. Let's come to this situation. So I'll come to 2021. I will do this. 2021, I will do this. So I'll come to 2021 financial statements now. I'll have 2021. Then I'll have my revenue or the profits now. Okay, I'll have profits of 20,000. Okay, then I'll have the depreciation of 5,000. That is in our books 5,000. We have 15,000. So I'll do my tax now. This tax will be 30%. Okay, which is something like 6,000. Okay, so I have information now that the tax authority is giving me more capital allowance. So this is what I'll do. I'll come here and say, okay, this more capital allowance that I'm doing now, what is the future implication? I'll be paying more tax. That is going to give me more tax expense in the future. Since a more tax expense and I want to make provision for that, I'm making provision for liability. So if I'm making provision for an expense, it means that today I have to treat that provision as an expense. So I'll come here and subtract this from my profit because it's an expense after today. I will pay tax, which is an expense I'll be incurring in the future. So the provisions today is supposed to be an expense. So I'll come here and do something like this. Then we'll be having our figure. Okay, we'll be having our figure now. What are we having here?
$8,400.
8,000.
400.
Oh, it's supposed to be 25,000. Sorry. This is 25,000. So I'm sure. Okay, this will be 20,000. Okay, so I'm sure this will be the same now. So what are we having?
13,400.
13,400.
13,400. Okay. Let's come to 2022 now. I will still have the same profits. Then I will now have the depreciation. Okay, I will now have depreciation. So I'll come here, I'll do my 20,000. Okay, then I'll have my 6,000. Okay, let's come here. What is the capital allowance that the tax authority is giving to us?
3,000.
No, 2022.
6,600.
They are giving us 3,000, isn't it?
Yes.
But how much are we charging?
5,000.
5,000. What is happening there?
2,000 different.
2,000 difference, isn't it?
Yes.
Okay. You can see that the effect of that 2,000, we have already created the effect of the 2,000, isn't it?
Yes.
Okay. We have already created the effect of the 2,000. I hope you can see that we have created the effect of the 2,000. Do you agree? Which is the 600.
Yeah.
Mm.
Okay. Okay. This effect now will be created in what? You can see that the effect is actually what? Referring in our current tax. Do you agree? The current tax that the tax authority will give to us.
Yeah, sure.
Okay, you can see that the current tax that we are paying 6,000 what? 600. But in our book is what? It's 6,000, isn't it?
6,000.
It's six
Okay.
thousand.
So
Mm-hmm.
since this particular 600 is actually what? Reflecting our current tax, we just have to now remove the provision because the provision has not been captured in the current tax that we are paying, 6,600. Okay. If it's supposed to be 6,000, that's where the provision will still be there to make it to a 6,600. Now the provision has not been transferred to what? To our what? Our current tax plan. It means that we have to remove the provision for our books. Removing the provision, what we do? What do we do? This will not be treated as income.
God.
Okay. Because the provision was what? Was a credit. Now we want to remove it. We have to debit. Okay. So we have to now remove the what? Remove the provision. Okay. This will be treated as income. That you can see this is actually a tax. That is why I'm adding this one. Okay. This is an income. We are now taking it to the current tax. We are now taking that one to the current tax because our current tax is what? 6,000. But the tax authority is now saying that we should pay 6,600. It means that we have made a provision for the 600 already, which is the additional one. So we just move this particular 600 to the current tax. So we come and debit this provision and go and credit the current tax account. Okay, we debit this and go and credit the current tax account. What we are trying to do is that we are reversing the provision. So the provision will not be treated as an income. So I'll come here, I'll be having something like, give me the fund answer.
14,600.
14,600.
600.
Okay. So we are just trying to remove the impact of that. So there's nothing like a deferred tax that you're going to be paying. Okay. You are just trying to estimate the impact of differences in the treatment of a particular item that is allowable for tax purposes, but has been treated differently. So if it is treated differently, it might be giving you more tax today, or it might be giving you a higher tax today, which you are going to be enjoying for it in the future. Okay, if the case is like this, I will give you the items. We cannot mention all of them. You can also have even you can have employees benefit that is going to be having a tax issue, shared based payment that will be having a tax issues. We have a lot of them over there. So I'll just mention some of them that will be giving you tax issues. Then we look at how to go about them. Okay, let's try a different thing, see something. Okay, let me come to a situation where this will now be. So let me see if I can scroll. Okay, that is going to be fine. Let me come to a situation where over here, let's come to so let's do the reverse of this. Okay, let's see that our okay in the books of the company. So let's come to the company here. So let's see we have the company here. So we have 2022 and we have 2021. Okay, so I will say that our profit over here. Okay, let me just use 1 year. Let me just do 1 year, 2022. Okay, let's assume that our profit over here it is 25,000. Okay. And we are actually charging depreciation, profit before depreciation. The depreciation that we are charging is actually 6,000. So we'll be having 19,000. And our tax is 30%. What are we having? What is the tax figure?
5,700. 5,700.
Okay, 5,000. Our focus is on the tax figure. All right, let's come here. The same profit, 25,000. But the tax authority is giving us 4,000. Okay, we'll be having 21,000.
That will be 6,300.
Okay, so we have 6,300. Okay, let's come here. Okay, we are saying that we are consuming 6,000 every year. we are consuming 6,000 every year. So we are anticipating what? A lower tax. But the tax authority is giving us what? 4,000, isn't it?
Yeah.
Okay. Okay. You can see this 4,000 is making us to pay what? A higher
No
tax.
tax.
Okay. But the 2,000 that we are saying that we are consuming in excess over here, this 2,000 will be giving us what in the future? Is it going to be giving us a lesser tax in the future or more tax?
Let's
Yeah.
add.
It will be giving us a lesser tax in the future, isn't it?
Yeah.
Okay. What would be the lesser tax that this 2,000 that we can see that we are suffering for it, isn't it? Okay. They're supposed to give us 6,000, but when they are giving us 4,000, it means that additional 2,000 will be available for us in the future, which will be taken from our tax before we pay what? We will be taken from our profit before we pay tax. Okay. So what is the impact of these 2,000 that we are suffering from right now? You do 0.3 multiplied by
30%.
that
And
will
now
be
100.
that will be 600, isn't it?
Yeah.
Okay. You can see that this is going to be a form of tax credit in the future for us, isn't it?
Yes.
Okay. So we treat this as what? Deferred tax asset is giving us a form of what? A form of what? Tax credit. So we treat this like a tax credit to the income because in the future this will be going to be giving us it's going to be reducing our tax. So when is this happening? It is happening now. So we are just making a provision using our accrual basis of accounting. The thing is happening now. So it's creating a tax credit for us in the future. So we are just making provision for that. At the time, this will eventually be transferred to the current tax that we are paying. So it will be transferred. So we now, if we are transferring, we now credit this and debit the tax and debit the profit or loss account. We transfer it to profit or loss. We debit the profit or loss account. So if the time comes, it will now be treated as well. So we come here and treat this as income because it's creating a tax credit for us in the future. So we make provision for it now. Okay, we make provision for it now. I'm using depreciation because we use items that are allowable for tax purposes. Okay, so if we come to the issue of deferred tax, you have to look at two items. Whatever I'm calling over here, we call it temporary difference. But you can see that I'm looking for the difference over here using depreciation. Sometimes we can use the carrying value of the asset. Assuming the asset is actually assuming this ruler. What are you doing here? Oh, okay.
Yeah, who is worrying you?
It's Nana.
Okay. So let's come here. Let's come to this particular one. This ruler.
Don't mind them, senior.
Oh no, nobody. Me, I'm a hard guy, so nobody can worry me. Okay. So
Oh, the girl they worry you.
no girl can worry me. Okay.
If
Unless
you
I want to
come,
be worried.
if you
Please, the
come,
UPSA,
when
the
you do last
UPSA
say,
student, you have to keep quiet. UPSA, please keep quiet.
He's a UPSA student.
yes.
Yeah, he's the one saying girl, nowadays. This.
Mm,
You can see that it's a sign that what I'm saying.
You are not
I hope you
serious.
will get it. Okay. It's a sign.
No, it be like
But you, what have you been saying? What have you been
UPSA
saying?
lady they worry am. UPSA lady they worry am.
You both should not worry. I mean, you will graduate. People that are writing level 3 right now will graduate in October. So you go there on Friday, go early, okay, and just go there. You go and stay at UPSA there. Just walk where they have the UPSA hostel. So in the evening, you can say you are going to be taking a walk. Maybe I will just come there. I can postpone some class in the evening and we take a walk there. And you will see things. Okay. Okay. Let's come
So
to.
what are we likely to see?
Well, I don't know, but I know that you see things. Okay.
It's
So
okay, say it's okay. Let's continue.
Okay.
let's move on now to okay. So if you want to, this is just the issue about deferred tax. So if you want to determine, I want to use carrying values, but I will use a carrying value letter. So if you want to determine the deferred tax, first of all, you have to look at two issues. Okay. You have to look at two issues. Okay. You have to look at two issues. The difference in the difference in accounting profit and taxable profit is caused by two issues, but we look at only one of them. Okay. So these two issues, we call something temporary difference, and we also call the other one that was temporary difference and permanent was difference. Okay. But unfortunately, our brother, which is permanent, we don't look at it because it is caused by items that are not allowable for tax purposes. So items like entertainment expense, okay, entertainment expense. So you have entertainment expense, the tax authority will disallow the entertainment expense on the basis of they have rules, they have the is it necessary or they have some holy and some things. Okay, they have some principles that they have been using. So
Only
this
exclusive and necessary.
okay. So this particular one, this particular entertainment expense is not a cause that we have to incur necessary to generate revenue. So they will disallow this one. This disallow is going to be for just a year. So it means that it is not creating any future tax consequences. We only use items that are going to be creating future tax consequences for the tax. So this entertainment expense is not going to be creating any future tax consequences to us. Okay. Another one is also can be the fines. So if your driver is not doing anything, is not behaving very well, and yet he or she has been fined by dodging or maybe not obeying the rule of the red means stop and those things, the tax authority will not take this one because this is being incurred by the issue of negligence. So they will not do this one. And also impairment on goodwill. Okay. Tax authority does not keep goodwill in the account. They don't recognize goodwill. So if there's an impairment on goodwill, goodwill is not recognized in the first place. So impairment on goodwill, and it's also not going to be causing what? A permanent, it's not going to be causing a deferred tax because it's not something that is going to be allowed for tax purposes, that the treatment is going to be different for what? For some time. It's not going to be creating any tax consequences in the future. We only look at items that are going to be creating future what tax consequences to the entity. And these items are allowable for tax purposes. So permanent differences, it is not going to be allowable for tax purposes, and it does not cause any future consequences of tax issues for the entity. So there's no deferred tax issue on them. But the issue of temporary differences, they are those items that are allowable for tax purposes, but mostly it's going to be for different accounting period. So the first one is the depreciation. The entity is going to be charging depreciation, and the tax authority is going to be charging capital allowance. So there can be a differences in these items. It can be as a result of the rates that they are using. So the tax authority will be giving you more capital allowance now, which is reducing your tax liability now. In the future, it is going to be creating or it's going to be increasing your tax liability. So make provision for that increase in your tax as a result of what is happening now because of the accrual basis. Okay, as far as the transaction occurred, we put it in our books, whether cash or something has been done, we put it in our books. Okay, so the first one, which is temporary difference, they are items that are allowable for tax purposes. And the basic thing that you are going to be seeing is the depreciation, issue of depreciation and what? And capital allowance. Another one is also research and development expenditure. What do we call research and development was? Research and development expenditure. What do we call research and development expenditure? Research and development expenditure, it is just we are creating or we are developing a new product. And the entity will incur a cost. Under IAS 38, which will be our next topic, the entity is allowed to capitalize the cost of developing that product if it is visible, if it is entity is sure that the product is going to be giving them commercial benefits and they will be producing or they will go ahead with the product. What will happen is that the cost of developing that product must be matched against the revenue that the product will be generating. So we capitalize it. But what happens with the tax authority is that the tax authority will expense this amount. They will give you, if it's 100 million, they will give you all the 100 million as at when it has been incurred. So if this has been incurred for this year, they will write all of them to what? To your, as an expense, to your profit or loss. They will give full capital allowance on this amount for you. But you are amortizing this over 5 years. What it means is that a capital allowance or allowance that you're supposed to enjoy for 5 years, you have enjoyed it in just a year. What it means is that if you are doing this at the end of the year, it means that you have actually taking 20 to profit or loss already. You are left with what? 80. This 80 has already been enjoyed in this year. So this 80 will not be available in the future, which you'll be subtracting from tax. So you'll be subtracting 20 every year. The tax authority will not subtract the 20 because they have given you 5 years thing now. It means that that will not be given to you in the future. That is going to be creating the tax consequences. What is the tax consequences? You multiply by the 80 that has been. You have enjoyed all the 80 now. So you just multiply it, maybe 20%. It means that over the remaining 4 years, you are going to be suffering a tax of this particular one every year. So every year you transfer to current tax. Every year you transfer each one, each year. So you have 4 years now. After 1 year, to level 60. It means that you have 3 years more. Then after that one, you'll be having 40. You have 2 years more. Every year you'll be transferring. Okay, so we have the research and development 1, 2. That is also one of them. Another one can also be an issue of loss on inventory. Loss on what? Inventory. Loss on inventory. So there can be a loss on inventory, which the question will tell you that the loss on inventory is only allowable for tax purposes when the inventory has been sold. So what happened is that during the year, this is what happened. During the year, the cost of your inventory was 10,000. Okay, but you have rating it to a net valuable value of 8,000. Okay, you are rating this one to a value of 8,000. So you are suffering 2,000 now, but the tax authority is telling you that they will only allow this for tax purposes when the inventory has been sold. You know that the inventory will be sold. Okay, the inventory will be sold. So it means that the inventory has not been sold yet, but the tax authority will subtract the 10,000 from your profits in the future. But you are going to be subtracting only 8,000. You can see the tax authority will give you 2,000 more. So this loss will give you a form of tax credit in the future because you are suffering for the 2,000 now. In the future, the tax authority will reimburse you with that particular figure. So you'll be having what? You will be having a tax credit. So we know the tax impact on this one. So loss on inventory. Okay, loss on inventory will also be there. We can also have interest payments. As far as the item is going to be allowable for tax purposes, it is going to be giving either additional tax in the future as a result of what is happening now, or it's going to be giving you less tax in the future. So you just make provision for that now. Okay, so we can also have provision on unrealized profits. Okay, provision on. Okay, don't worry. I'll talk about that one at the latter part of this one. Whenever you are doing group accounts, there is a provision for unrealized profits. That unrealized profit is going to be creating a tax implication, and we'll be looking at that one later in our discussion. How do you determine whatever you are going to be using to charge your deferred tax? Very simple. Your deferred tax can be a deductible. Deferred tax can be a taxable difference, or deductible difference. What do you mean by taxable difference and deductible difference? Taxable difference is where whatever is happening today is creating additional tax obligation for you in the future. So what it means that you are enjoying today and in the future you'll be suffering. So that is going to be giving you more tax in the future. So that's a taxable difference. That will be creating a tax liability for you. That will be creating additional tax expense for you. So taxable differences are always treated as an expense at the same time liability. Because whatever is happening now, it is benefiting you. In the future, it's going to be creating a more tax liability for you and more tax expense. So we make provision for it now as a liability and as an expense. But if you come to deductible means whatever is happening now is going to be creating a tax credit for you. So you are the one losing now. So it's going to be creating a tax credit, and that tax credit will be in the form of what? a form of asset because it's going to be a tax credit. The tax authority have to give you that credit. So it means that it's an asset to you. Okay, so this will always going to be treated as what? A credit or income. So let me just say this is going to be treated as income or assets. Okay. How do we know this is a taxable difference or temporary difference? Taxable difference is where the tax authority is giving you more capital allowance once you are charging less depreciation. The deductible difference is where you are charging more depreciation, the tax authority is giving you less capital allowance. It means that more capital allowance will be available for you in the future, which you are going to be deducting for your profits. So you'll be paying less tax in the future. Okay. How do you determine your temporary difference? You can see that the time that I was calculating the deferred tax, I don't know how you write deferred tax now, but I'm sure the time that I was doing my BC and SHS, I'm sure this is how you write it.
One
So,
F. Yeah.
okay. So you can see that what I've done over here is I just look for my tax rates and I multiply by the difference between the depreciation and that one, which we call the temporary difference. Okay. The temporary difference, mostly we determine it based on what? Based using liability method. What do we call liability method? We compare the carrying value of the assets with the tax base. Very simple. Let me use what we have done first. Okay. The first one you can see that I'm saying that the value of the asset was actually 2021. The value of the asset was actually 10,000. So the cost of the asset was 10,000. But the depreciation that we have charged for that year was 7,000. Was 5,000 rather. Okay. It was 5,000. Okay. Then the this particular the tax authority will also carry this particular assets in their books at 10,000. Okay. But the capital allowance that they are giving to us is actually 7,000. What would be the carrying value of the assets in our books?
It will be 5,000 and 3,000.
It will be 5,000 and 3,000. Okay. What is the difference between them now?
2,000.
Difference is 2,000.
Okay. The difference is 2,000. This 2,000 is because the tax authority is giving more capital allowance, which is reducing our tax liability now, and this will increase our tax liability in the future. So this is the same as a temporary difference. So you can see that I'm getting the difference between this one. The temporary difference that you'll be calculating, which will be from depreciation and capital allowance, that is the temporary difference for the year. So that will be for the year. What will be the temporary difference for? That is just for the year. But the one that you'll be calculating using the carrying base, the carrying value of the asset, that is going to be the temporary difference as at today. As at today, because we are using balance sheet item. So that is as at. Balance sheet is prepared as at. Profit or loss is prepared for the year. So when you are calculating the temporary difference from the profit or loss side, where you are comparing capital allowance and depreciation for the year, you are calculating the temporary difference for the year. But what would have been the total provision as at today? We use this particular one to do it. Okay, let me bring another one again. Let's say the value of the asset is actually 10,000, but we are charging a depreciation of this one. Let's say this is 10,000. So every year we are charging depreciation of 2,000. Okay, 2,000. So this will be 2,000 every year. Let's say we have done 2 years. Okay, that will give us 4,000. Okay, let's say the tax authority is giving a depreciation for 4 years. It means that every year they will be charging us 2,500. Okay, so for the 2 years now, it will be what? It will be
6,000 and
6,000 a year and 5,000. Okay. What is the difference?
1,000.
Okay. This difference is related to just 1 year.
No.
No, asset.
No. You can see that it is 500 for the 2 years, isn't it?
Yes.
Okay. So if you are using liability method where you are comparing carrying values, whatever difference that you are getting is the difference from the time that the asset has been bought. So this should be the total provision. which is the same as 500 for each year. So this will be 0. Let's say 25. Maybe you are getting something like uh, maybe 80 or something. Then this year too will be another what 0.25, 80. So you can see that every year is 80, 80, which is given at 160, which is the same as there was the 25% on this. So this is supposed to be something like 125, 125. Okay, but I'm just using that one. 125, 125. So you can see that we put this year is 500. This year is 500. If you put the two together, it's 1,000 for the 2 years. So what should be the implication of what additional capital allowance that we have enjoyed? So in the next 2 years, we are going to be paying tax of 1,000 of 250 on the profit that we make in the next 2 years, because we have enjoyed the capital allowance for those 2 years now. So we just calculate 0.25 multiplied by 250. This is giving us the provision as at today. As at today. If we go next again, it is going to be giving us the provision from the date of the asset to the end of the third year. So if you do profit or loss, sometimes the question can give you that the capital allowance chart for the year is this, the depreciation chart for the year is this. The difference that you are getting over there is the movement in the capital allowance for the year. That is the movement in the capital allowance for the year. Why is it movement? We have made a provision of 80. In the next year, we're supposed to make 80 again. So this is an increase to this one. So it means that the provision has increased by 80. So whatever you are getting from profit or loss, that is the actual movement. That is the actual movement. But if we are doing it every year, if we are doing it using balance sheet method, this is what will happen. It means that the first year I'll do it and I'll have 125. But they are now saying that at the end of the second year, the provision is supposed to be on 1,000. So if I calculate it now, we're having 250. It means that the provision is supposed to be 250, but I have 125. So I have to increase my provision by 125, which is the same as 84, which is the same as 500 for that year, 25% of 500. So after creating this one, deferred tax is just a provision. Provision is just like any other provision. Increase will be added as an expense. Decrease will be subtracted as an income, just like provision for doubtful debts. Okay, so we'll be picking a question on just the normal temporary difference. Whatever is happening over here is going to be taken to profit or loss because it's happening between profit or loss item. Sometimes we can revalue the asset. That will be creating a different problem for us. How do we deal with it? Okay, so let's just take a very simple question and deal with it. As far as the item is allowable for tax purposes, and there's a difference in the treatment, it is going to be creating a deferred tax implication. So let's deal with just one question. And how do we go about it? Deferred tax is treated as non-current liability because it's going to be related to an item that will last for maybe more than 1 year. And the additional tax that the deferred tax is creating is always adjusted against what? Current tax. What do we mean by to be adjusted against current tax? It is tax. So since we have current tax, we either add it to the current tax or we subtract it to the current tax. So I will now expand our 4 months for the tax schedule now. I will now expand that one using the issue of the deferred tax. I will now expand that format now. So I'll come here, I'll have my tax schedule. Okay, tax schedule for whatever we are doing. I'll have my tax schedule for whatever I'm going to be doing here. So I'll have tax schedule. Okay. So I have my tax schedule, which will be like this one. Then I'll have my current tax. The current tax is the tax that I'm currently paying, whatever be the case. But since the deferred tax and then the other tax issues are under or over, so I'll come here. So I'll come here, it will be under or over provision. That will be adjusted against this one. So this can actually be positive or negative, depending on what we are having. Then we count to movement in deferred tax. What do we mean by movement in deferred tax? It is just the increase in the deferred tax. The deferred tax is the provision. So movement in deferred tax. Okay. So this can also be positive or negative. depending on what is happening. Okay, then we just have it over here. If we are creating a tax expense for the deferred tax, that is an expense will be added to the current tax. Okay, but if it is going to be a reduction, which is a tax credit, it will be taken away from what? From our current tax. It's supposed to be taken away from profits. But since it's tax, we just put all of them together and have tax. Deferred tax does not reduce our current tax estimates. Deferred tax does not reduce our current tax estimates. As in the statement of financial position, it does not change it. That particular thing has not happened yet. But we are saying that if this will happen, we are going to be paying this tax in the future. Okay, that is not reducing it. So we still show our current tax and also show deferred tax as different item. We don't put them together. They will all be shown as liability. If deferred tax is an asset, we will show the deferred tax as an asset and also the current tax as difference. Okay, that is it for that one. So we just pick a very simple question. Then we move on to the issue of revaluation of an asset that was also going to be creating a deferred tax. Then issues of losses. When the entity is making losses, what is going to be the issue? So we look at that and then we now look at extreme situation for deferred tax, which is going to be the issue of group accounts. We look at that one, then we just move on to other stuff. Randy, are you there?
Yes, sir.
Okay. Let's look at this. Okay, mostly I saw the three. Let's do the three. Let's do the three. Okay.
Okay. The Links Limited is an agro-processing company which reports under International Financial Reporting Standards and prepares its financial statements up to 31st December each year. The company intends to comply fully with IAS 12 income taxes by introducing deferred tax in its financial statements. On January 1st, 2020, the company acquired an item of land which cost 750,000 Ghana cedis and has a useful life of 5 years with low residual value. The Links Limited enjoys capital allowance at a rate of 30% per annum. Revenue generated by using the plants is taxable, and any gain on disposal of the plants will also be taxable, and any loss on the disposal of the plants will be deductible for tax purposes. The Links Limited estimates current tax provision for the year ended 31st December 2020 as 10,125 Ghana cedis. The tax rate of the Links Limited is 25%. Required. In accordance with IAS 12 income taxes, explain the amounts to be reported in the statement of financial position and the statement of profit or loss for the year ended 31st December 2020, and explain the temporal difference. Explain the temporal difference and state one circumstance in which temporal difference may arise.
Okay. So do you think there will be an implication of deferred tax here?
Yeah,
Okay. Why do you think so?
because of the capital allowance.
Capital allowance is 30% and the tax is 25%.
Oh, okay. So there's going to be a difference in that, isn't it?
Yeah.
Okay. So be using the liability method, we find a carrying value. This one just for 1 year. You can use the profit or loss method where you find a difference between your capital allowance and also your depreciation. Okay. The tax authority is going to be giving you more, whilst you are giving you what less. Let me say this again. Okay. Whenever the tax authority is giving you capital allowance, okay, they don't consider the residual value until the asset has been sold. So when you are giving residual, as when you are giving residual value over here, the tax authority will still give you the capital allowance on the full amount. until the asset has been sold, they don't consider the residual value. Okay. So if you are calculating your depreciation will actually be calculated on, let's say the residual value is 50,000. If the residual value is 50,000, your depreciation will be based on 700,000 divided by 5, isn't it? Okay. But the tax authority will be calculating their capital allowance on the full amount, so 0.3 multiplied by 750,000. Okay, they will consider the residual value when the assets have been sold. That's why they do the capital allowance. Okay, that's it. I don't think maybe if they will bother with that one, but it's just something I'm saying. That is very important. Okay. So let's come to question number 3. It means that you just write your normal English. This transaction is going to be creating a deferred tax implication because the depreciation rate of the entity is different from what the capital allowance rate. So the entity will be enjoying more capital allowance now, which will be creating more tax obligation. Okay, more tax obligation in the future. So what do? We need to determine the deferred tax. The deferred tax is just the amount that we are enjoying now plus the tax rate. So we'll be paying the tax on that amount in the future. So we just come here. It is going to be the tax rate multiplied by the temporary difference, the difference between the carrying value of the asset and then the tax base. The tax base is just the carrying value of the asset in the books of the tax authority. Okay, so let's determine the carrying value of the assets. The carrying value in the books of the entity is going to be the cost minus what? Depreciation, not accumulated depreciation, because it's just 1 year depreciation. So I'll come here, I'll be having 750,000 minus what? 750 divided by 5. Is that correct?
Yes, sir.
Okay, what are we having? 750
minus 150.
150,000. So what are we having? We are having
600,000.
600,000. Let's calculate the tax base now. We say the tax base is the same as carrying value of the asset in the books of the tax authority. So you come here and do your tax base. So your tax base is going to be the cost of the asset. The tax authority will always carry the value as cost. There is nothing like revaluation loss. There's nothing like impairment in their books. Okay, so we have less the capital allowance. Okay, less the capital allowance. So the depreciation for them is the capital allowance. So we will come here and have 750,000 minus into brackets 0.3 multiplied by 750,000. Okay, what are we having? 750 against what?
Minus
To be 225,000.
225,000.
Mm.
Okay, what are we having?
To be 5,000.
5 to
5,000.
5,000. So what is happening now? You can see the tax authority is giving us how much more?
75.
He's giving us 75,000 more.
Okay. So that 75,000 more, it means that that portion of the profit will not be available for tax purposes. So in the future, we will pay tax on 75,000 that has been given to us now. So I'll come here, my deferred tax. It means that this will be creating additional tax for us. This is a taxable temporary difference. Taxable temporary difference. It is going to be creating additional tax expense to us. They are giving us more capital allowance, which is going to be reducing our capital allowance in the future. Since our capital allowance will not be enough in the future, we are going to be paying higher profits. So I'll just come here and have, what is the tax rate for them? 0.25. Okay. Multiplied by, then I'll just come here, 600,000. 600,000 minus what? 525,000. You can see that it's the same as the difference between the capital allowance and what? And the depreciation. Okay, I hope you can see that. Okay, so we have here, we have our, okay. So we pay tax of 25% on that. What are we having? 0.25.
18,750.
Okay, 0.25 multiplied by the 75,000, 18,750. Okay, you can see the difference between the capital allowance and the tax base. Capital allowance and the depreciation. Can you see the difference? 225 and 150. Okay, so we come here and do our tax schedule. Okay, we come here and do our tax schedule. Okay, you can see that the current year, what is the tax that we say we are going to be paying? What is the current tax? What is the tax that we are going to be paying on the profits?
N125.
Okay, so our current tax is what? 11
N125.
10125. Assuming there is no deferred tax, our current tax for the year would have been 10125, isn't it?
Yeah.
Okay.
Yes, sir.
But the deferred tax, we can see that there is no base. So the provision that we are going to be making is the same as what? The 18.75. This is creating additional tax expense in the future. So we treat it now as an expense. So you can go to your profit or loss and subtract current tax of 10,125 and come and subtract a provision for the deferred tax. But since they are all tax, put them together. Okay, that's what we adjust it. Okay, but this one, there is no basis, there is no previous deferred tax. Maybe the deferred tax can actually be, previous one can actually be something like, let's say 20,000. The deferred tax balance from the previous year is 20,000. But they are saying that the provision is supposed to be what? 18,750. You can see that it has reduced by 1,250. Okay, so we now go and reduce the 20,000 to this one. So this is a reduction in provision, which is going to be treated as a gain. So we come here and subtract. But there is no previous balance. So this is the first provision that we are making. So we charge all of them to profit or loss. So what is the total there? What is the total for the two figures?
It's 625.
There's
It's 625.
28.
It'll be 28875.
28875. Okay.
Yeah.
So this is what we'll be taking to profit or loss as tax expense, but we come to statement of financial position. So I'll just show some extras here. Statement of profit or loss, or you can write English. Okay. An
Okay.
amount of 28,875 should be taken to profit or loss as tax expense. How much will be taken to current liability as current tax?
10,125.
Okay. So I have 28875. And I'll come to statement of financial position. You will split these amounts now. So I have current liability. I have current liability. That will be the current tax, which is going to be based on the current profit. So I have the current tax liability of the 10,125. Then I'll have non-current liability. You can see that the asset is going to be for what? For 5 years. So this liability, deferred tax, will be costing the difference for 5 years. So we treat it as what? As non-current liability, 18,750. Okay. We are going to be looking at the impact of deferred tax, on, okay, what is temporary difference?
The difference between the tax base and the current value.
Okay. Okay. No problem. The temporary difference is caused by an item which are going to be allowable for tax purposes but for different words, accounting period is going to be treated in a very different way. Or the difference between the carrying value of the asset and the tax is very simple. What is going to be causing this is what? The issue of depreciation. Okay, issue of depreciation. Tax authority giving a different value as capital allowance and entity also charging. It can also be caused by the treatment of research and development expenditure. It can also be caused by the treatment of loss on inventory. It can be caused by the treatment of a lease liability. Okay, the lease liability, you see that you'll be having a right of use against your lease liability. So the right of use giving you assets. If you should pay tax on assets, it means that you are going to be paying. That the liability, when you pay, you are going to be incurring a cost. So that will give you a tax credit. So they can give you information on the leases. You will compare your right of use with your lease liability. The right of use and assets. So assuming you are paying tax on the asset, it's a liability. Okay. Then if you come to the lease liability, it's expenditure that you are going to be making payments. So if you make a payment and the tax authority is giving you a tax allowance, that is going to be an asset to you. So you compare the two figures and look for the net amount and apply the tax rate on it. So they can also give you information on the leases. They can give it to you on employees' benefits, share-based payments. You just look at the difference. If it is employees' benefits and the net amount every year is a liability, it means that you pay that amount to the people. If you are paying that amount, the tax authority will give you a capital allowance on the amount that you are paying. But since you are going to be paying that amount, if it is being paid, it is going to be giving you a tax credit. So you make provision for that tax credit. So if it is a net obligation, it's going to be giving you a deferred tax asset, which will be treated as well as a tax credit. Okay. So they can give you anything. We look at the impact of deferred tax on other comprehensive income. What do you mean by other comprehensive income? We are looking at the issue of revaluation. Okay. This one is also important for consolidation, where there's a fair value adjustment that will automatically create deferred tax. So you'll be able to understand that issue from this side. Okay. We say that the tax authority does not revalue the assets, but the entity has the option to carry the asset at cost model or revaluation model. The entity has the option to carry investment property at cost model or fair value. The entity has an obligation to carry out financial assets at either amortized cost, profit or loss, or other comprehensive income. But the tax authority will just carry this item at the cost. How much did you buy the item? 10,000. Then they will be giving capital allowance on it. Let's come here. Assuming before any revaluation, okay, the carrying value of the entity assets, was, let's say, 150,000. Okay, and the tax base was actually 125,000. Okay, at the end of the year, the value of the assets has been revalued to, let's say, revalued to 175,000 now. Okay, let's say all these value are 31 December. Okay, so we are revaluing the assets at the end of the year. Okay. What would be the value of the assets now in the statement of financial position at the end of this year?
175.
175,000. Okay. And the tax base will be what?
125.
Okay. What will be the temporary difference now?
25.
50,000.
Okay.
50,000.
That would be 50,000, isn't it?
50,000.
Okay.
Mm.
The temporary difference is calculated just the value of the assets against what? So 175 against 125. I hope that is fine now. Okay.
Yes.
Yeah.
So let's come to temporary difference now. Okay. So we count to the temporary difference. Okay. This temporary difference will now give us 175,000 against what? 125,000, which is going to give us what? The 50,000. Please, is this 50,000 mainly coming from depreciation? Difference in capital allowance and depreciation?
No.
No.
No. So we cannot take the deferred tax over here to profit or loss. The only portion of deferred tax that will be taken to profit or loss is that particular temporary difference is caused by a profit or loss item. You can see that The difference that is caused by a depreciation is what? It's 25,000.
Yes.
Okay. The revaluation surplus is adding what?
So there another 25,000.
25,000.
So you see that difference caused by depreciation should be what? Should be 25,000. And the difference caused by revaluation surplus is what? 25,000. Okay. Revaluation surplus is not taken to profit or loss. So we cannot take the impact of deferred tax on 25,000 to what? To profit or loss. But depreciation is taken to profit or loss. Okay, so we take the impact of this one. So what you have to do is very simple. You have to separate the temporary difference relating to profit or loss and the temporary difference caused by the revaluation surplus, so that I can be able to know the portion that will be taken to profit or loss added to the current tax and the portion that will be taken to retain earnings. So if our tax rate is now 25%, our total deferred tax will be based on this 50,000. But this 50,000, we are going to be sharing it differently. Deferred tax for the year will be 25% on this, because that is the total temporary difference. But this cannot be taken to profit or loss. Total cannot be added to current tax. So what we do is that, okay, what is the temporary difference that is relating to profit or loss item? 25,000. What is the one over here? So we come here and do 0.25, 0.25, and we share now. So we go to revaluation surplus. We have revaluation surplus. Then we subtract the deferred tax from it. Then this one, which is relating to depreciation, will now be added to the current tax. If it's an addition, maybe we assume that there's no previous deferred tax. Sometimes it can be a deferred tax. Another way of doing this is also like this. Okay, you can calculate your total. You can calculate your total what? Total deferred tax. What is the total deferred tax? What is the total deferred tax? 25% on this. 25% of 50,000. What are you?
12,005.
12,500, isn't it?
Yes.
Okay, this 12,000 is calculated on 50,000, isn't it? Okay,
Yes,
okay.
sir.
In this 50,000, 25,000 is for profit or loss. 25,000 is for profit or loss. So you can just share it based on the portion that is for profit or loss and the portion that is for revaluation surplus. So I'll just come here, 25,000 divided by the 50,000, because it's the 50,000 that I'm sharing. Okay, then I'll multiply by 12,500. Then I'll count to this one to 25,000 divided by 50,000 multiplied by 12,500. Okay. But what you do is very simple. Determine the portion of the temporary difference that is for revaluation surplus. You do it and you take it towards revaluation surplus account. The one that is relating to profit or loss, you will now find the difference or whatever that one is causing towards to the current tax. So the only thing that we add to the current tax is the temporary difference or deferred tax relating to temporary difference that is caused by profit or loss items. So I'll just do the extras, how you do the deferred tax one for revaluation surplus. So you come here, you have the other comprehensive income. Okay. So we have our okay, so we have other comprehensive income like this. So you have the other comprehensive income like this. Okay, for the year. Then you bring your revaluation surplus here. Okay, you bring your revaluation surplus here. And what you do is you bring your 12,000, 25,000. Then you now bring your deferred tax element on it. It means that only 75% of these will be taken to that one. So you have 0.25 multiplied by the 25,000. So you have 6750 or something. Is it 67 or 57?
62, 50.
Okay, fine. Okay. So that's what you do. But in your statement of financial position, so it means that your 5750 will also be added to the current tax because this is just the first time of doing this provision. But in your statement of financial position, your total deferred tax will be 0.25 multiplied by 50,000. Why 50,000? It's going to be deferred tax for profit or loss plus deferred tax for what? Statement of finance for other comprehensive income. So there are two different deferred tax. So you put them together and do whatever you are now doing. Let's pick one question. Then we
Hello,
look at
sir.
the issue. Yes, please.
Is how are we getting the 5750?
Say 6250.
62.
50.
Okay. 6250. Okay, no problem. Okay. So let's do something here. Let's do something here. Let's do something. Let's do something. Let's do something. Let's do something. What are you going to be doing? Right. Andy, 4. Read the following is something.
Question 4.
Yeah.
WS revalued its property, plants, and equipment upwards by 100,000 for the first time in 31st December 2016. Its reporting date. Prior to revaluation, the carrying value of the property, plants, and equipment was 850,000 Ghana cedis, and the tax base was 625,000 Ghana cedis. The WS tax rate is 25% per annum. Its deferred tax liability brought forward in respect of property, plant, and equipment was 62,000 Ghana cedis required. Prepare the journal entry required to record the movement in deferred tax in the year ended 31st December 2015 in the financial statement of WS Limited.
Okay. So let's come here. Let's come here. Very simple. Let's come here. Okay. Please, land is not allowed for. Land is not what? Land is not. We don't charge depreciation on land, but whenever land is revalued, it will automatically increase the carrying value. So we still do the first tax on what? On the revalued amounts. Okay. So very simple. But you have to be aware of that. So the entity revalued its what? Its property upwards by the first time for what? For 100,000 on 31 December. Its reporting date. Okay. Prior to the revaluation, the carrying value of the property, plants, and equipment was 850,000. The tax base was 625,000. The tax rate is 25,000. A deferred tax liability brought forward in respect to property, plants, and equipment was what? 62,000. Prepare the journal entry required to record the movement in deferred tax in the year ended 31 December this and this. Okay. Before the deferred tax, before the revaluation, what is the carrying value of the asset?
850,000.
Okay. Assuming there was no revaluation, what would have been the temporary difference?
That would be
It will be 850 minus 625.
That would be
Okay.
That would be 125,000.
Okay. So we come here. Okay, you have to just determine this. Very simple. So we come here, we look at the carrying value of the assets. Carrying value of the assets before the revaluation. The carrying value is 850,000. And the tax base is what? The tax base is 625,000. Okay. Revaluation surplus at this date is what?
600,000.
Revaluation surplus at this date.
100,000.
That is 100,000. They have revalued their asset by 100,000 for the first time. It means that the value has increased by this one. Okay.
Yeah.
Now, your total temporary difference will now be this. Okay, if you count to the total temporary difference, you just calculate it on the total basis, but you should be able to separate it. It will now be 950,000 against what? 625,000.
625, yeah.
Okay. What is the total?
325,000.
Okay. 325,000. But you should be able to know that this 325,000, 325,000 is not mainly caused by issue of capital allowance and depreciation. So you have to separate this now. So you look at deferred tax, deferred tax, deferred tax for OCI. Okay, deferred tax for OCI. That will now give you 100,000 out of this is for what? Is for the OCI. So what will be the deferred tax caused by that particular one? What are we having? 25,000, isn't it?
Yeah.
Yeah.
Okay. So we come to deferred tax that is relating to profit or loss. So come here. You can see that would just be 850 minus what? This particular figure, which will be 0.25 multiplied by 225, isn't it? Okay. 225,000. What are we having? 5?
5,650.
Okay. Let's come here. Let's now do something here. Okay. What is the deferred tax brought forward?
62,000.
Okay. Do we have any deferred tax relating to revaluation surplus as part of this, or this is purely relating to profit or loss?
Purely related to profit or loss.
Why?
Because it's brought forward and the revaluation upward was done at the end of the year. And the brought forward happened at the start of the year. So it's purely related to the P&L because the asset was revalued first time at the end of the year.
Now that you are talking, I just want to hear the first time. Okay, I was just waiting for you to talk and say, what if the assets have been revalued in the previous year? It is going to be creating deferred tax. We are doing the revaluation for the first time, so there is no deferred tax relating to revaluation at the date of the revaluation. So the 62,000 is brought forward for profit or loss item. But the total provision now should be how much? What should be the total provision? We say that when we are using the liability method, whatever deferred tax that we are getting is supposed to be the total provision as at that date. Okay, so in the books, we are having,
But, sir,
yes, please.
but how did we get the 225,000?
You are part of the people who mentioned that figure to me.
No, I mentioned 325,000. That's
No,
the
it's because
950 minus.
no, the first time that I heard that without
Okay,
the
the first time you
revaluation.
mentioned it all.
I
Eh?
asked for the first time that if there is no revaluation, what would that be
All
the
that
deferred tax?
deferred tax.
Okay.
And you mentioned the 225, which is the 850 against the 625,000.
Yeah.
Okay. So let's come here. This is relating to profit or loss. This is the total deferred tax as I did
Sir,
this.
please, we can't see your
It's not
board.
sure, yes.
Sir, please, I
So
can't
wow.
see your screen. Oh.
Relax.
Okay,
Relax.
sir.
The
Is
screen
this
is
ruler is
relax.
worrying you?
Linus,
Yeah?
you go UPS.
This
I mean, I
ruler
didn't
is
know.
worrying you.
No, I was thinking I was sharing the board with you.
You go
So I was
UPS.
actually right. Okay.
Okay.
So actually, I have some good students at BPSA there, but just that the people that are not serious are plenty. So I
Yeah,
also
sure.
consider
If
them.
yeah is
Hello,
one.
sir.
Okay.
Sir,
Yes, please.
hello. Please, so how did we get the 950, please? 950,000.
The revaluation surplus plus the carrying amount.
The problems are plenty. Okay. They say that okay. They say that the property has been revalued upwards. Okay, upwards by 100,000. It means that we have increased the value of property by 100,000 for the first time. They say prior to the revaluation, the carrying value of the asset was 850,000. So without the revaluation, the carrying value of the assets is 850. Now we are increasing this value by 100,000. So the total value, including the revaluation, will now be the 950. I hope that is fine.
950, yes. Okay, thank you.
You're welcome. Okay. So let's come here. So our deferred tax brought forward. Okay. Deferred tax brought forward. Let me just say deferred tax balance or brought forward. Deferred tax brought forward. Okay. Brought forward is 62,000. But we are saying that the actual deferred tax will be what?
56250.
So what do we do now?
There's a reduction in the deferred tax.
By how much?
Reduction.
Okay, reduction is how much?
That's 5.5750.
So we have 62,000 against 56250. What are you having?
5,750.
5,750. If provision is reducing, what do we do?
Will be deducted from our current tax.
No, just a normal provision. If your provision for doubtful debt is reducing, how do you treat it? Income or an expense?
It's an income to us.
Okay. So this is what we do. They say you should do a journal entry. So this is what we do. Okay. You come here, you go and debit your deferred tax. Okay.
Liability.
What do we mean by debit deferred tax liability? You debit with a 5750 because in the deferred tax account we are having 62,000 there as the balance gone down. So you have to now reduce it to what? To 56,250. So we go and debit this one now and credit what? Profit or loss, which is the same as crediting the current tax. But we don't have current tax here, so we cannot subtract it from the current tax. So you come here. This is relating to the profit or loss one. This is the deferred tax caused by what? Caused by the depreciation. Okay, but what happens to the deferred tax for? What happens to the deferred tax for what? For
So you
revaluation.
will go to the OCI. You will go to the OCI and reduce the OCI balance.
So we debit other comprehensive income. You can see the revaluation surplus is a gain, isn't it? So we are crediting into the OCI. So reducing this one, we go there and actually what? Debit the OCI with 25,000. And what will happen? We credit what?
The liability, deferred tax.
Deferred tax
with 25,000. So our total deferred tax will now be what? 56250, which is for profit or loss, plus what? 25,000 for OCI. Okay. But it's just that we are treating it differently. One will go to profit or loss, one will go to what? One will go to other comprehensive income. So let's see here. So let me do this here. Let me just do the statement of financial position right here. So statement of financial position. We don't have any current tax, so non-current liability. Okay, sorry. I have to show the assets. Let me show everything. So I'll come here. I'll have non-current assets. You can see that I'll be having the PP at what? 950,000. Do you agree?
Yes, sir.
Okay. So I have non-current liability. That will give me the deferred tax. Okay. Let me do the deferred tax very simple for you. That will be 0.25 multiplied by 325. What are you having?
81,250.
81,250, which is the same as the one, the 56,250 plus the 25,000. Okay. I'll count the equity here. Okay. So the equity I'll have revaluation surplus. Okay, that revaluation surplus will be 0.75 multiplied by what? 100,000. That will be 75,000. It is 75,000 because we are taking 25% of it to defer tax,
Yes.
and we are keeping 75%. Okay. We are going to be looking at issue of losses. Okay. What about the entities making losses? Okay. Those of us that we have done maybe basic taxation. You can see in Ghana over here, the law is so flexible that if you are starting business and you are making losses, they don't want you to, maybe you might be employing people to work for you, okay, or you might be doing that work to feed your family. So if you are making losses and we are still charging you, no, you are making losses, we cannot charge a loss, but you are making losses and you have made loss for like 5 years. But immediately you start making profits, we are not charging you. So it means that we don't even care about you. The losses that you have made, we don't even care about that one. And we are now charging you as soon as we start making profits. If we do that, maybe we might discourage you from doing business because we did not even consider you when you are making losses. Now you started making profits. We have started what? Taxing you. Okay, that is not fair. You have to say, okay, since you have made losses, now we actually allow you to recover your losses. Then, if you start making profits, we will start charging you taxes. So what happened is that in Ghana here, entities are allowed to carry over their losses. Okay, entities are allowed to carry over their losses for a period of time. First, they do it priority center and not priority. Right now, I learned that whether you are doing cocoa farming or whatever, it is going to be 5 years. You carry over your losses for 5 years. First, it was 5 and 3 years, depending on where you're operating. Okay, so you carry over your losses for 5 years. What it means is that if you have made losses, okay, let's say the current year you have made losses of 25,000. Okay. And the next year you have made losses of, let's say, 28,000. Okay. For the 2 years, you have made losses of 53,000. Okay. It means that if in the future you are able to make profits to cover the 53,000, or let's say next year you are able to make a profit of 100,000, the tax authority will not charge a tax on 53,000 out of these profits because they will allow you to recover your losses before they will charge taxes on the remaining figure. Assuming the losses were not there, they would have charged you tax on zero. They would have charged you tax on all the 100,000. They have charged you tax on all the 100,000. Are you paying tax of what? 25,000. But since you have made losses now, they will charge you only tax on 47,000. Okay, so you can see that you are going to be saving a certain amount of money as a result of what? As a result of the losses. So whenever a loss is made, the loss is now creating a tax credit for you in the future. Why? The loss that you are making today, in the future, the tax authority will allow you to subtract that particular losses. So the consequences of these particular losses is that it is going to be given as a tax benefit in the future. That is going to be given as a tax benefit in the future. So we provide for that tax benefit, which we call a deferred tax asset, because the losses will give us a tax benefit. We will not pay tax on the portion of the profit that we are going to be making, which will be recovering our losses in the future. But when do you estimate this particular deferred tax asset? You have to be very sure about the amount of profit that the company will be making from its existence. If our losses is now, let's say, what I've done over here, our losses is actually was 53,000. But as far as the entity can operate, can operate to whatever number of years that will be in existence, the entity can be able to make only 50,000 profits. As far as the entity is going to be in existence, they can only make a profit of 50,000. Can you be able to subtract all your losses of 53,000?
Okay.
Can you be able to recover all the 53,000?
No, sir.
No, sir. No, sir.
How much can you recover?
Only 50,000.
So it means that in the future, you only not going to be paying profit on what? On the 50,000. So you make
1,000.
provision to cover only the 50,000. So 0.25. Okay. So the issue of deferred tax on losses, you only make the provision for the portion of the profit that you are very sure that you can make to what? To write off the loss against. If you can be able to make profit that will cover all the losses, it means that the tax authority will allow you to recover all the losses. So all the losses that you have made will create what? A deferred tax, or will create a tax benefit for you in the future. So you make provision for that one because it's creating a deferred tax one, a tax consequences for you in the future. What is happening now? It is creating that one. You make provision for it. Okay. But if the losses that you have suffered, you cannot be able to make profit to cover all those losses. You cannot make provision to cover all the losses because you are not going to be getting tax credits on all the losses. So you make provision on only the portion of the losses that you can make profit to cover. Okay, so this is whenever there is losses, it's going to be giving you a deferred tax asset, which is going to be a deferred tax credit. So it treats it as an income. Okay, so if you are given a question, they can say the entity has made a losses for 2 years and the losses is less than 75,000 Ghana cedis. And the question will tell you that the entity is very sure to make only the maximum amount of profit that the entity can make is up to 50,000. You make provision for deferred tax based on what? Only 50,000. It is only 50,000 of the losses that you can recover. So this 50,000, you will not pay tax on this 50,000 in the future. So you just make provision for it. And that provision will be treated as deferred tax assets. Deferred tax assets. And you debit deferred tax asset, credit what? Profit or loss, or you subtract it from your current tax when you have current tax. Okay. That is how we go about it. Losses will be creating what? A deferred tax credit for us in the future. So that is going to be an asset. We treat it as deferred tax assets and we treat it as a tax credit to the current tax reduction. Okay. Let's come to the issue of deferred tax when we are doing business combination. Very simple. Okay. When we are doing business, so we just solve one question or maybe two questions within that time, then we just move on. So consolidation, when we are doing issue of deferred tax and consolidation. Okay. You can see that under consolidation, we are going to be having a net asset of the subsidiary, isn't it? All these net assets at the date of acquisition, what do we do? At the date of acquisition, what happens to the net asset of the subsidiary?
Fair value.
The fair value. If the fair value, what will happen? It can be a fair value increase or a fair value decrease, isn't it?
Yeah.
That's it.
Okay. When there's a fair value increase, that is giving us a revaluation, isn't it?
Yes, sir.
Yeah.
Okay. That is automatically going to be increasing our current base over the tax base. So if the value of the asset was actually 10,000, the assumption is that the tax base is also 10,000. If you now revalue this asset, you increase the value by 20,000. It is now going to be giving a carrying value of 120, and the tax base will still be what? 100,000, because the tax authority does not fair value. So you can see that we are going to be having a temporary difference of what? 20,000, which is just like a temporary difference caused by what? Caused by revaluation. So this is going to be creating a deferred tax at acquisition. So you have 0.25 multiplied by that. At reporting, what will now be the increment? Maybe the asset is depreciating by 5,000 every year. You can see that at reporting, this is now going to be 115,000 against, let's say, the same 100,000. You can see that the difference will now be 15,000. So your temporary difference will now be 15,000. You now charge the deferred tax on that one. So fair value adjustments or a reduction in fair value, it is going to be giving you a temporary difference, which is going to be creating a deferred tax. So in the same way, we can also reduce the value of the asset by, let's say, 10,000. So 10,000 over a year, it means that we are going to be having 90,000. Okay, so these laws that we are suffering now, the tax authority will allow us to subtract it from our profit when the asset has been sold. So these laws that we are doing over here is creating a tax credit for us in the future. So what do? We now calculate a deferred tax on the 1,000, but it's not going to be additional tax. It is going to be a tax credit. So it is going to be a deferred tax to us. So whether there is a fair value decrease or increase, a decrease or increase, it is going to be creating a deferred tax implication there. And we have seen that. Okay, we have started consolidation for corporate reporting, and we have seen that in the question that we saw. Whenever there's a fair value adjustment, it will create a deferred tax implications. Very, very simple. Let's come to the issue of another one. You can see that at consolidation, there will be an addition to the net asset of the what? Of the subsidiary. That addition is what? There will be an item, there will be an asset added to the asset of the subsidiary. What is the name of that asset? At acquisition. The goodwill. That is goodwill. Okay, goodwill is going to be increasing that one. Okay, so let's come here. Okay, let's also come here. Assuming the net assets of the subsidiary at reporting at acquisition. Okay, let's say at acquisition is the same as the tax base of the asset in the books of the tax authority. So let's come here. Let's say the carrying value of the assets. There's no fair value adjustment. Okay, let's assume there's no fair value adjustment. So the carrying value at acquisition was actually 100,000, and the tax base is also the same value. Let's assume. Okay, there's going to be 100,000. So you can see the temporary difference is 0. Okay, let's now see that we are adding goodwill. We are adding goodwill to the value. So the goodwill will increase. The goodwill belongs to the subsidiary. That's why if the parents sold the subsidiary and the parents lose control over the subsidiary, the goodwill, the parents will not have access to the employees and lose it again. So it means that the goodwill is for what? Is for the subsidiary. So whoever is coming to buy the subsidiary will now have access to that. So let's come here. We are having a carry value, the same value as 100,000. But the goodwill arising from acquisition now is 100,000. That is going to be giving us one thing. And what? And the carrying value of the tax base is going to be how much?
100,000.
It's going to be 100,000. Tax authority does not recognize goodwill. What is happening over here? You can see there's a difference of what?
10,000.
Okay. But does the tax authority recognize goodwill?
No.
Will you enjoy
No.
anything on goodwill for tax purposes?
No.
No.
So the goodwill is a permanent difference. It's something that is causing a permanent difference. Goodwill is not allowable for tax purposes. You are not going to be by any chance to receive anything on goodwill for tax purposes. So it's not creating any tax implication for us in the future because this is not taxable. Okay, so goodwill is going to be increasing the net asset. It's going to be creating a difference, but that difference is called permanent difference. So it doesn't create any temporary, any deferred tax implications in the future because it's not allowable for tax purposes. So that is issue of goodwill is not treated. Okay, but let's come to issue of provision for unrealized profits. Okay, what you have to know is that the group account that we are preparing, okay, the group account does not exist. Okay, in terms of business, group does not exist. We have not registered a company as a group. Okay, it is the two companies, the parent and then the subsidiary, that has been recognized legally as an entity. So those are the two entities that we can tax. We cannot tax the group because the group does not exist as a legal entity. It is the two entities that we are putting together to form the group. So these two entities are legal entities. So they are there to be taxed. So we can tax them as a legal entity. What it means is that we cannot tax the profits of the group. Just that it is the tax of the two groups that we put together. That's why if we are doing consolidation, we don't tax the profits. We just add the tax expense of the two companies. Because the group does not exist as a legal entity. No company is registered as a group. It's the individual company that has been registered as a legal entity. It's those entities that we are going to be charging tax. Okay, so what happened is that we are going to be adding the tax expense of the two entities. Okay, let's come here. If there's an intra-group transaction, which we are going to be looking at on Wednesday, how do you deal with the intra-group transaction and why do we remove the intra-group transaction? Very simple. We'll be looking at that one, but you just have to just take it like this for now. Okay, where there is intra-group transactions and all the goods has not been sold, what do? We remove the portion of the profits on the goods that are yet to be sold, isn't it?
Yes, senior.
Okay. So let's say the profit on the goods, the total profit on the goods that the parent is selling is 3,000. You see that the parent will recognize all these profits in each individual financial statement. Do you agree? When
Yes,
the
agree.
goods has been dispatched, the parent will recognize that one as revenue, and the parent will recognize the goods sold as cost of sales. It means that the parent will recognize all these figures as profits.
Profits, yeah.
But they are now telling you that some of the goods are yet to be sold, and the profit relating to the goods that are yet to be sold, the goods are still within the group. So the goods are still with the parents because the subsidiary is part of the group. It means that we have not sold the item, we have not transferred ownership from that item because the goods are still within the group. When do we recognize revenue? When ownership has been transferred. Since the goods are still within the group, that is not a sell because we still retain control over the goods. The goods are still under our ownership because the subsidiary belongs to us. The goods is still within the group. So we cannot consider the portion of the goods that are yet to be sold as revenue. It means that we have to reverse it. So they will say portion of the goods that are not being sold is the profit on it is 1,000 is 500. It means that we have to remove 500 from the books of the parents. But you can see the time that the parent was estimating its own profit, they assume that they have sold the goods and they have 3,000 in their profits. And the time that they are estimating taxes, the tax has been estimated on all the profits on the goods, which is going to be what? Which is going to be the 3,000. So they are now charging tax. The time that they are estimating their individual tax, the individual tax is the figure of the parent. It is based on their assumption that the goods has been sold to the subsidiary. So they are estimating tax if the tax is 25%. The tax that they have in their account is based on the total profit of what? 3,000. Okay. And that tax will give us how much? What is the tax estimated for the 3,000, which is the individual financial statement of the parent? 25% on this.
750.
750. Okay. But what is the actual profit now?
2,005.
2005.
So what is happening? What is
250.
happening to our tax? You can see that we are what? The tax estimate that we are doing over there is too much, isn't it?
Yes.
Okay, we are charging 500 in excess. So since we are removing 500 from our profits, the tax element relating to the 500 should also be removed. So we have to come here now and do 0.25. What are we having?
125. 125.
125. So it means that the tax should have been something like maybe, is it 675, isn't it?
Mm-hmm.
The tax on should have been 675. But
Yeah.
in our tax expense, the parent is having in the tax expense of the parent is having tax based because the tax will be taken from the individual financial statement of the parent. So the tax was based on total 3,000. So we are having 750 over here. The actual tax should have been what? Should have been 675. So we come and subtract the 125 from this one. Because since we are removing the profits, the tax must also be removed. So we come here, we come and subtract it over here. It means that the tax liability in the books of the parents must also be something like 750, which we have to come and remove under the what? Current liability. But what we do is we don't treat it as a reduction. We rather maintain the 750 and treat this one as the fair tax was
Yeah.
assets.
Mm-hmm.
Okay. So you can see that we have the same effects. Okay. Okay. This one, as far as consolidation is concerned, they have not said anything about this one before. But a time will come and they might say something about it. And you have to do the deferred tax. It can be a transfer of PP. There is going to be a gain. The parents might be transferring at fair value, whilst the parents are supposed to be transferring at cost. So there will be a gain over there. We have to reverse that gain because you cannot sell to yourself. We have to reverse that gain. And that gain in the separate financial statement of the parent has captured that gain in estimating their tax. Since we are removing the gain, it means that the tax element relating to that gain must also be removed from the tax expense. That's what we are doing over here. So this can also create a deferred tax what implication when there is intra-group trading and this is done at what? At profit. It can also be done as loss. The parent will be suffering the loss, but the tax authority will say that the loss will be deductible for tax purposes when the goods have been sold. It means that will be creating a deferred tax asset for you as well. Very simple situation. We will just look at the last sitting corporate reporting question and maybe we look at another one in addition in that format again. And okay, please, I don't actually see, okay, I'm not a seer, but last time, that we are doing income tax, okay, we have solved this question, okay, and I said that the way the corporate reporting is going right now, they can give you a question in this format. What is the format? There's one format here, okay, I'm sure, yeah. It's not this one. Maybe the question number. Yeah, I'm sure it's this 17 that we solved. Okay. Where they will give you information and ask you to determine deferred tax yourself, temporary difference yourself, and calculate that one. Even the one that I've been giving in the corporate reporting is simpler than this one. Okay. So they are now changing the direction of the questions. Okay. They are now changing the direction of the questions. So whatever we are doing, we should just look at it very well. But let's look at the 19, the 18 for now and pick one of those ones and we move on. 18. Randy. Randy. Say yeah. Kezia, can you read?
Question 18.
Okay.
Amugi.
Kezia, no. Okay.
Okay.
Sinagodi.
Question 18.
Okay.
Amugi, public listed company, is a producer of soft drinks. Recently, Amugi has been experiencing financial difficulties attributed to a recession. Extracts of statements of financial position and statements of profit or loss for the year ended 30th June 2024 are as shown below. So we have the statement of financial position as at 30th June 2024 extract. And then the statement of profit or loss account for the year. The current amount of land and buildings included in property, plant, and equipment in the draft financial statement above was 144 million Ghana cedis. Depreciation for the period of 14.4 million on property, plant, and equipment has already been accounted for. The market value of the land and buildings as assessed by professionally qualified valuers was 151.2 million Ghana cedis as at 30th June 2024. Gains and losses on property are taxable or tax deductible on sale. The tax base of all property, plant, and equipment at 30th June 2024 was 150.48 million. Losses incurred in the year ended 30th June 2024 that can be recognized for tax purposes. That is after taking into
account disallowable expenses amounted to 23.04 million Ghana cedis. In the industry in which Amogi operates, tax losses can be carried back for 3 years and then carried forward indefinitely. Amogi made a profit in the previous 3 years sufficient to absorb the current year tax losses. Amogi pays tax at 25% and the tax losses will be applied at that rate. The rate is not expected to change. The deferred tax liability in the above extra statement of financial position is the figure at 1st July 2023. There were no temporary differences other than those noted above. Current tax assets and liabilities can be netted in the tax regime. Required. Using financial statement extracts, set out the financial accounting treatment of the above items in accordance with IAS 12, income taxes. Thank you.
Okay, so you can see that this one is going to be about two issues, isn't it? We are going to be having deferred tax due to profit or loss, and deferred tax due to what? Revaluation. And this deferred tax is going to be about losses and also about depreciation and other stuff, and also the non-comprehensive income. Okay, what I will do is very simple. Okay, I will just go straight forward and determine the deferred tax that will be due to profit or loss. How will I do that? Deferred tax that will be due to profit or loss relating to property, plant, and equipment, or as a result of the difference between the revalues, difference between the depreciation and capital allowance. What will I do? I will just pick what? The carrying value. You can see the value of the property, plant, and equipment over here is before what? The value over here is before the revaluation, isn't it? Okay. The tax bill that they are going to be giving to me, is it going to be including the revaluation of the item? The tax bill that will be given to me.
No, it will not include that one.
Okay, so what I will do is I will just use the existing carrying value of the asset before the revaluation against the what? The tax base. That will give me temporary difference relating to profit or loss. Then I will come and determine the deferred tax that will be caused by the revaluation. Very simple. So I will do this. I will not do it as a total because I might get confused on the total. So I'll come here. I'll do question number 12. Okay. Question number 12. I'll have I'm give whatever they are saying. Okay.
Question
I'll have
number
this
18.
18. Sorry. So I'll have question number 18. So I'll come here. Okay. They say you should set out. So we are just going to do a financial statement. So if you want to write it, it's fine. Okay. So I'll come here. I'll say temporary difference. Okay. So I'll say temporary difference. Temporary difference to profit or loss. Okay. So I'll come here. I'll have my temporary difference to profit or loss. I'll have my temporary difference. Okay, to be the carrying value before the revaluation minus the tax base, because the tax base that will be given to me, it is without the revaluation. So let's go to the statement there. What are we having as the carrying value of the assets? I'm having 214. Okay. 210. Okay, let's check that again. 210. Okay, 214 rather. So
214-080.
okay, so I have 214,080,000, isn't it?
Yes.
Minus what? What is the tax base given to me?
150,480.
Okay. 1, 5. Okay, I think
040.
I think we should determine this in million, isn't it? So that would be
Yes.
okay. So this will be 214.08, isn't it?
Yes, but you can use you can hold the 1,000 and then use what they are saying.
This one is working, okay. So unless you have to say all these figures are in thousands, so we can do 21.08. Okay. So the zeros is supposed to be 4 for that one, but it's supposed to be 4. So let's do it. Let's just write all the zeros. So I'll have additional 0 here. Okay. So I'll have 1, 5 what?
150
Okay.
480,000.
Okay. What is the difference?
$63,600.
6.
6,600,000.
636.
100,000. 6,360,000.
Okay. That is the temporary difference from profit or loss. Okay. Another 0 again.
Yeah.
The zeros are 5.
Yeah.
Okay. So let's come to the deferred tax to profit or loss. So the deferred tax to profit or loss, it will be 0.25 multiplied by 6,360,000. Okay, what are we having?
1,5,900,000.
1,5,900,000. Something like this.
Yeah.
Okay. Let's come to the temporary difference. The deferred tax that will be taken to profit, that will be taken to other comprehensive income. So let's come here and do the revaluation. Okay. We come here and do the revaluation. So revaluation of property. Okay. So let's come there. Let's do the revaluation surplus here. Okay, revaluation surplus. Okay, we need to determine the revalued amount of the item. Okay, what is the revalued amount?
That's 151.2 million.
Okay, and what is the carrying value?
The current value is 144.
Okay, please, they say depreciation has already been charged. Okay, depreciation has already been charged. So they just give that depreciation for nothing. So I'll come here and have 151. So I'll have Y15. Is it 151?
Yeah.
151, 200,000.
Okay. So this one we can actually use that one against what? 144. What are we having?
151.2.
7.2.
7 points. Okay. So you can see that what will be the deferred tax on this one?
7.2
This is
million.
okay.
2
Deferred
million.
tax on this one will give us 0.25 multiplied by
7.2.
what are we having?
1.8 million.
1.8
million.
Okay. So we now come to the losses now. Okay. There will be a deferred tax asset on the losses. Okay. Don't go and do this one and say you want to determine the total. If you determine the total value, if you determine the total value of the assets, it is going to be complicated for you. You have to separate the portion that is for revaluation surplus and the portion that is for profit or loss. So just do your profit or loss first and just come and determine revaluation surplus. Do it and do whatever you want to do. So let's come here to the losses now. Okay. Very important to pay attention to the losses. Okay. The loss for the year is actually what? From the extracts, what is the loss for the year?
11,520.
11,520. Okay. Let's come here. They say the losses incurred in the year ended 30th June 2024 that can be recognized for tax purposes. It means that after the tax people have now done the tax audit, our losses is actually what? 23.04, not the 11.52. Okay, so the losses that we should be taking or we should be charging for tax purposes. This is what we are having in our books. This is the loss that we are saying we are having for accounting purposes. Okay, but the tax authority is saying that the losses that we have to, the losses that has been made for the year which we supposed to charge against our profit for tax purposes supposed to be 23.04. Okay, which of these losses are you going to be enjoying the benefits on in the future? Is it going to be the 11.52 or is it going to be the one the tax authority is giving to you? Which of them is going to be giving you the tax benefits?
The one the tax authority is giving.
The
Okay.
23.04.
Both will give you, but if you are using the 11.52, that is you are underestimating your what? Your benefits. Okay. So we use this one, 23.04. Very, very important. Okay. In the industry in which the entity operates, tax losses can be carried back for 3 years. It means that the tax losses that you are charging here, you can actually take them back. Okay, you can actually take them back and assume that you have enjoyed or that particular tax benefit for that 3 years. You can calculate the losses for if you have made profit for that 3 years already. You can actually take your losses that you are enjoying to the last 3 years. The last 3 years means that you assume that you have enjoyed the benefits already. So you treat that particular one as tax credit immediately. It's not going to be in the future because you are writing it against the previous losses. So it will be treated as tax credits immediately, not a future tax benefit because you are taking a loss back. Since you have made a profit for the last year, you just assume that those losses should have been taken away from the profit that you have made over those years already. So the tax authority will allow you to treat those ones as a current tax credits because they are relating to the past. So immediately are tax credits, not to the future. Okay, that is the meaning of that. Amogi made profit in the previous 3 years sufficient to absorb the current year tax losses. So what we are going to be doing is that we are not going to be making or we are not going to be providing for these particular ones as future tax benefits. I hope you are getting. They say they have made profits in the past to absorb the current losses. It means that whatever loss that we are enjoying now will be treated immediately. It should have been enjoyed in the last 3 years, but we have not enjoyed, so we treat it immediately as tax credits, not something that will happen in the future. It is not going to be written against profits in the future. If it is going to be written against profits in the future, that's why we treat it as deferred tax assets because it's creating a future tax consequences. But this is going to be written against profits which has already been earned. So it means that the tax authority have agreed that write it a tax credit immediately. Okay, so we come here and they have made a sufficient profit to absorb the current tax losses. So Amogi pays what tax at the rate of this one. So we have to find our tax credits on this particular one. So what will be the tax credit on the losses that we are making now? What will be the tax credits? So we have 0.25 multiplied by 23.04. Is that correct?
Yeah.
What are we having?
5.76.
5 points what?
76.
Okay, 5.36 million. Please,
No,
I would like us.
77.
Okay, sorry.
5.76.
5.76. So we have 5.76 million. Okay, let's come here and they say something about the deferred tax there. They say the deferred tax balance in the extracts statement of financial position is a figure at July 2023. There were no temporary difference other than those noted above. Current tax assets and liabilities can be netted in the tax regime. So it means that current assets and current tax liabilities can actually be written off against each other. Let's come here, please. What are they saying? The deferred tax over here, what are they saying? Is it an opening balance or closing balance for this year?
It's opening balance for this year.
For this year. But do we have any information about a revaluation has been done in the previous year?
No, sir.
No.
So we assume that this figure is actually for what?
Profit or loss.
Okay, profit or loss item. So let's look at the movements in deferred tax now. What is the current deferred tax relating to the profit or loss item? 5,900, isn't it?
Yeah, 1,500.
It's 5,900, is that correct?
Yeah. Then the asset.
Okay. So let's now look at the movements in deferred tax. What is going to be the movement? The difference. So movements in deferred tax. What is the movement? What is the movement in deferred tax? Okay. Movements in deferred tax.
Simply about the asset.
Which one? The tax credits?
Yeah.
No, it's not deferred tax. It's actually a tax credit because it is for previous year, so it's not for the future. It is always for the future. When the word is deferred, it means that it will not be enjoying now. We are taking it to the future. Deferred. Okay, but this is relating to profit that has been made in the past already. So we cannot defer because the profit has been made. So we enjoy immediately. If you have done work for me in the past and I'm paying you now, you cannot say this money is for the future. No, it is for the past. So this is actually tax credits. So it will not come as what? As deferred tax. This is not going to be enjoyed in the future. It is going to be enjoyed in the past. Okay. It is relating to profit that has been made in the 3 years. So this is actually a tax credit, not a deferred what? Deferred tax credits. No. Okay. So let's come here and determine that movement. So we have the balance July 1, 2023, which is what? 13,080. Is that correct?
Yeah.
Okay. But the balance at the end now, balance at June 2024, supposed to be what? 15,900. What is the increase?
That's 2820.
Movements in deferred tax. Is what?
2820.
28,
20.
20. Okay. So let's come here to we do profit or loss, but I'll do something here. Okay. So I'll come to statement of profit or loss. Statement of profit or loss. Okay. I'll come here. Depreciation has already been charged, isn't it? So I'll come
Yes,
here.
sir.
There's no current tax expense, isn't it?
Yes, sir.
Okay. So let me just write tax expense here. Look at what I'll do. So I have tax expense over here. Okay. The tax expense will be 2820 minus what? What is the tax credit?
5.76. 5760.
50.
760.
Okay, so that would be 5760. Okay, 5760. Okay, are we paying or are we going to be paying? Is there going to be a tax expense or is going to be a tax credit? What I mean?
Tax credit.
Tax credit of
Of
290.
how much?
2940.
Okay, 2940. So this is going to be positive. If it should be an expense, we do this one. Okay. They are all tax. That's why I'm putting it like this. If you count to other comprehensive income, what do you have? What are you going to be having? You have your revaluation surplus of how much?
7,200.
7,200.
7,200.
Deferred tax is how much?
1,800.
1,800. Okay. What will be our total deferred tax now? It will be the 1,500 plus what?
1,500 plus the 1,800.
You can see they say current tax liability, current tax asset can be subtracted from current tax liability. You can see that the tax credit is a current tax, but what we have over here is deferred tax, is a non-current. We cannot net, or we can only net current tax against current tax assets and current tax liability. So the netting cannot be done. So if I count my statement of financial position, this is what I will do. I'll just repeat those items there. So I'll have the extras, I'll have my non-current assets. But my non-current assets will be something like this. I'll have the PP to be, what is the value there? It is 214080 plus what? 7,200. Do you agree?
Yeah.
Okay, revaluation. Okay, revaluation is not a reporting. So I'll have that figure now. Okay. Then we have current assets. Current assets will be what? Tax credit, isn't it?
Yeah.
What is the tax credit?
The tax credit is
57.
57.
Okay. What will be your deferred tax?
The deferred tax will be 17.
What is the total?
17,700.
17. 1,800 plus 15. Okay, 17,700. Okay, you can show your revaluation surplus under equity. That is it. Okay, this one price even is not complicated like the way I was saturating it. Okay, so that is, please, I can also have any questions, but you can try this one. Okay, you can try the 15 on your own. Okay, so maybe to be part of the final more consulting, but one of them over here I've included in the financial reporting. I don't know whether, yeah, I'm sure it's the 17th, so that one I can do it. Maybe I'll solve it when we are doing intervention. But this is just about deferred tax, and this is just about income tax. Okay, income tax. I don't think somebody worry with anything, but if they should give you a question, I'm very sure it will be at the same format as Google reporting.
I want to. So, can you go back to the workings? Not forgetting.